Up next, the Senate Banking Committee, chaired by Democratic Senator William Proxmire, hears testimony on the recent steep decline in the stock market.
Committee will come to order. Chairman Reuter, let me first thank you for appearing before this committee to discuss the recent turbulence in the stock market. We know how very, very busy you are and what a trying time this is for you, and so we're very grateful that you've come before us to give us your opinion. I also want to thank Senator Domenici, who should appear momentarily, and if you would permit, we would like him to testify first. He'll only testify for a very few minutes. Senator Domenici is one of our most valued members of the Senate. He's a brilliant man, as you know. He's been head of the Budget Committee. He's now the ranking member. He's been engaged in the so-called summit that's been going on between the administration and the Congress, and presumably that may have had something to do with his delay. I suppose there are about as many explanations for the stock market turbulence and the drop in the stock market on Black Monday as there are economists. To me, the stock market was just overpriced, very badly overpriced. It was selling, as you know, the S&P 500. We're selling at 22.3 times earnings, which is much higher than, in my view, than it should be. So the fact that it dropped was not shocking. It's still well above what it was at the beginning of the year, and higher than it's ever been in the history of this country prior to 1987. I think it's still probably overpriced. At any rate, we're delighted to have you, and I'm sure you can give explanations on some of the technical aspects. It wasn't so much the fact that the stock market went down as that it went down so suddenly, and it's been so enormously volatile. 500 points in one day on the Dow Jones Index, and a huge percentage drop, bigger, I guess, than we've ever had, except in 1914 or so, when the situation was, of course, entirely different. So we'd like anything that Congress should do. Perhaps we should do nothing. But what we should do, in your best judgment, and what you think the SEC can do under the circumstances, what changes there might be. Senator DeMauro?
Thank you, Mr. Chairman. Mr. Chairman, I'm here really to listen to Chairman Reuter, and I'm going to ask that my remarks, my prepared remarks, be entered into the record as if read in its entirety. Let me simply say this, Mr. Chairman. I think it's imperative that two things take place. That is, number one, that we, the Congress and the administration, come together with a multi-year package and as quickly as possible to demonstrate that we're committed to doing something with the deficit. The perception of our inability to come to grips with this when we have a window of opportunity. That window of opportunity was the crisis that we saw take place, and it was a crisis. It didn't become a full-blown disaster, but certainly it was a dangerous situation. And I'm very concerned, Mr. Chairman, that unless those of us in the Congress are willing to put aside partisan political considerations and do the business of the people and come up with a package, and it's going to mean some give and take on both sides, both on the administration in a policy that says no taxes, whatever the cost, and those who say that there are areas that are sacrosanct as it relates to making some budget reductions. Why, we're just going to have a repeat of that kind of situation with a down market and with a lack of liquidity to step in there because there's a lack of confidence. And so, Mr. Chairman, there are some questions that I'd like to ask of Mr. Reuter as it relates to the Continental Illinois Corporation and what's taking place as it relates to their bailing out a subsidiary that's dealing in securities. What does he think about the margin requirements as it relates to the options, 5% in some cases and even less? Has that exacerbated the problem? And I commend you, Mr. Chairman, for withholding the rush to call these hearings, but for calling them now so that we can get the chairman of the SEC to give us some of his concerns, some of his thoughts, and his impressions.
Thank you, Senator DeMauro. Senator Riegel?
Thank you, Mr. Chairman, and let me thank you for convening this hearing today, some time now after the market collapse, to have a chance to engage in a measured discussion here with the chairman of the SEC. And let me ask first that my full statement be made a part of the record.
No objection.
And let me say to you, Chairman Reuter, that I appreciate the care with which you've prepared your testimony today. I think your prepared statement is one of the best that I've seen in a long time here in the Senate, and it comes not a long period of time after all this difficulty has struck the market. So I appreciate the care and the effort that's gone into your prepared testimony. I also want to say that I appreciate the time that you and your staff members have given to me as chairman of the Securities Subcommittee, as we have spent some interesting hours together over this last several days since the market turbulence. I think what we need to hear from you today, so that we can understand as best we can just what caused the market break, what seemed to be the key factors, and what, if anything, in the internal mechanics of the financial markets themselves may have helped bring this about or made it worse than it otherwise might have been. I think when we get a worldwide market collapse of this sort, that it has tremendous implications, I think very dangerous implications for the economic future, certainly for our country, but for every other country as well. I have sent to you, as you know, a letter requesting that the Commission reconstruct with great care exactly what took place leading up to the events of Black Monday and on that day and the days immediately following. And I trust that that work is now underway to try to fully lay out exactly what took place and what may have been some of the driving factors that were at work to take the market down over 500 points, as Senator Proxmire says, or to lose 22% of its value in a single day. So I will look forward to going over with you in the subcommittee in some careful detail exactly what that reconstruction shows us. I have made 3 recommendations, and I would hope that you'd comment on them today. One is that we create an international securities regulatory commission to begin to better regulate and coordinate international securities markets. Clearly, we are in a 24-hour-a-day trading market system now, and I think we need to understand the relationships between these markets and tie them together. I've also suggested the creation of a new independent special advisory committee to study the securities markets, similar to the special study that was conducted so successfully in 1963. And then also, and I know you have a strong feeling about this, suggested an immediate increase in the funding and the staff levels for the Division of Market Regulation and Investment Management, and to make sure that we establish an exemption for the Commission from the budget cuts that are now posed by Graham-Rudman. This is no time to be cutting back on the capability of the SEC. In fact, I think we're still significantly understaffed, and that's a problem of long standing that goes back over several years under the previous chairman, in which we've discussed at great length here in this committee. I've also heard reports, and let me stress now that they are only rumors, and so I want to find out precisely what the facts are, that during the events of recent weeks that certain firms may have sold for their own accounts before executing individual orders. And I want to find out if that is so, and while that kind of selling may be perfectly legal, I'm concerned about whether or not individual shareholders, the small shareholder, may have been shouldered out of the way in some situations by major holders of securities, including firms that may have moved ahead in order to look after their own interests rather than those of the small shareholder, and I'm very much concerned about that. Let me now turn to something that was developed here in May of this year when John Shadd, your predecessor, had his final hearing before this committee. He served longer, as you know, in your job than any previous SEC chairman. And I asked John Shadd on May 13th of this year in this room this question. I said, some have argued that given the number of market devices that are now being used for portfolio insurance and indexes of various kinds, that you might see the market in a given day not go up or down 150 or 200 points, but maybe 500 points. Is it also beyond the realm of realistic possibility in your view, or should we steel ourselves to the fact that we are now into a new condition with a different kind of market, with lots of new instruments, and the prospect of that kind of thing could be real? And Chairman Shadd's response, which is of course in the record, was as follows, quote, in terms of the probabilities of a one-day break of 500 points on the Dow Jones average, I would say that it's highly remote, very remote. I also asked him, quote, about the possibility of a market meltdown, quote. His response was, quote, I think there are an awful lot of reasons why that is highly, highly improbable. As for the meltdown theory, I just don't think it's likely. And then when you were here for your own confirmation hearing, we discussed these same issues, and you were asked by me, did you see any risks, and I'm quoting the question, did you see any risk that as a result of some of these new trading techniques, we might someday soon be headed toward a market meltdown? And at that time you responded, and I quote you here, excessive market speculation combined with new trading techniques may yield market volatility, but I have not seen convincing evidence that a, quote, market meltdown, presumably a market trading-induced dramatic fall in market prices, is imminent. Well, we've all had a chance now to learn from history, in a sense, and we have found that we were much closer to that condition than any of us would have liked. And so I hope today, in your elaboration on this very finely prepared written statement, that you will be as candid and as direct with us here as you have been in our private discussions, because I think we need to lay the facts on the table, decide what actions may be needed, and then step forward to take them.
Thank you, Senator Eagle. Senator Hines.
Mr. Chairman, thank you. Chairman, I suppose we're all agreed that what happened on October 19th is serious. We may or may not all agree on why it's serious. It's not just that people on Wall Street lost money. America lost. Pension funds lost. Many of us spent a lot of time trying to build up pension funds so that people had something besides Social Security to depend on. The consumers lost because of confidence in the market, and the small investor lost in the market. Businesses lost the ability to go to market and finance. The cost of capital for equity financing is 30 to 50% higher today than it was 3.5 weeks ago. So America lost, and lost in a big way. My second concern, I guess, is that we may have not seen anything yet. I say that for two reasons. First, we haven't seen, at least as of today, any evidence that we can govern. The market sent us a message on the 19th that was to get our fiscal house in order. And the housekeeping to date shows that everybody is out to lunch. Nobody is picking up the mess. Nobody is hauling the trash, and the deficit remains unattended to. Maybe that's why the market sent us a signal yesterday. I think we ought to take careful note that there is the possibility of a recession, and what that means for the future of all those people I mentioned, the consumer, the investor, the pensioner, the businessman who needs equity capital. On Monday, October 19th, the Standard & Poor's 500 stood at 225, or about 11 times estimated fiscal 88 earnings, estimated by analysts then about $20 a share. That's where it stood on the 19th. A recession estimate of earnings is $17 a share, and a recession multiple is more like 9. Multiply 9 times 17, and you get a very low number. You get an S&P 500 number of around 153. 153. Now, yesterday, the S&P 500 was about 250. What kind of a drop from 250 to 153? How much is that? The answer is about 30 or 40%. The answer is it's not a 508-point drop, it's about a 608-point further drop. Now that's what happens if the market goes into a recession psychology. I don't say there's a recession yet. I say that's what happens if we go into a recession psychology. Now, we didn't have a recession psychology on October 19th. We had some fears about inflation. We had some fears about the dollar, but the fears about inflation were ill-founded because commodity prices have been coming down. And by the way, they're down a lot since then, too. What happened was an intersection of technology with new products, the technology being such things as direct order transfer, program trading, the new products being the futures traded on the Chicago Mercantile. And we saw extensive volatility. The question, obviously, is if we could have a 508-point drop in the market which was not warranted by the fundamentals, given all of that technology, what would we have if the fundamentals did warrant a drop in the market? And I don't know the answer to that, Mr. Chairman, and I sure as hell hope we don't have to find out, because another 500 or 600 point drop in the market would guarantee that we would go into a hair-raising recession, because people, first of all, would have decided we're in it, and secondly, that kind of a drop would take us back to about 1980. It would tell people, hopefully wrongly, but it would still tell people that everything we've worked for the last 6 or 7 years had disappeared, gone away, no gain, lots of pain, 7 years. And the question that I think we need to address today, among others, and Don Regal has posed a lot of good questions, as has Aldamato and others, is, as we sit here, program trades, at least for accounts, not the institution's own accounts, have been turned back on. The computer programs are on this morning. Direct order transfer is on this morning. It was off up until this morning at 9:30. And I'd like to know whether the SEC thinks that we ought to leave it on, particularly with the risks that may be involved. Those are some of the questions, Mr. Chairman, I think we need to get to, and I think we need to get to them fast.
Senator Shelby.
Thank you, Mr. Chairman. Chairman Reuter, I too want to welcome you back to the banking hearing. We thought when we were having your confirmation hearings earlier you wouldn't be back so soon or under these circumstances, but we do welcome you. And Mr. Chairman, I want to commend you for calling this hearing, and I welcome the opportunity to have economic experts such as Chairman Reuter here to tell us what exactly occurred in the capital markets. The media, as most of us know, has many explanations. One, the budget deficit, $160 billion this year alone. This prosperity, as most of us know, has been purchased on credit. Last year we had $220 billion deficit, yet we had a bull market. Equally troubling is the trade deficit. We've got to close the gap between the exports and the imports. We've got to regain, again, our competitive edge. However, I don't believe that government's entirely responsible. Let's look at Wall Street, the Wall Street syndrome. The inventions, computers come under fire. We've got program trading. Some people look at that as a scapegoat. Portfolio insurance, index arbitrage. Are they really responsible here? Computers, as we know, trade large blocks of stock in seconds. The New York Stock Exchange pulled the plug. Many of people contacted me would like the computers unplugged for good, but can we do this in an age of technology and global markets? Overinflated stock prices that Chairman Proxmire mentioned. The market was built on optimism. The market was due a correction, but not so sudden, perhaps, or the Dow reached heights based on what? Some people say greed. The Dow plummeted because of fear. Washington, I think, can help eliminate some of the fear, but it's going to take Wall Street if anyone, to eliminate a lot of the greed. I recently signed Senator Conrad's letter saying to the people that are representing us in negotiations with the House and the White House too on deficit reduction that $23 billion is not enough, that we've got to go further because we're already hearing in the marketplace that it's got to be much, much higher numbers, 50 billion, perhaps more. I look forward, Chairman Reuter, to your insight here today, what we in Washington can do or must do, and what you on Wall Street must do to stabilize this economy, but namely to stabilize this market if it can be done. Mr. Chairman, I ask that my written statement be made part of the
objection be
record.
printed in full. Senator Heck.
Thank you, Mr. Chairman. I also welcome you, Mr. Reuter, and I think that during the past 2 weeks you've done a great job. I think John Phelan from the trading has done a great job. Every buy order was executed, every sell order was executed, and to bring gentlemen like yourself up and say what happened, you know, Congress is one of the greatest buck passers I've ever seen in my life. I was in the business world for 35 years, only in the Senate for 5 years, but since I've been here, we have an utter disregard for cutting the spending. Every spending bill right now is going up, but no one says about Congress and the horizon, mandated health benefits, parental leave, plant closing, minimum wages, all against the business people who do all the employment. Obviously, Congress cannot balance a budget, and what do they want to do? They want to raise taxes, which is counterproductive, and on top of that, a trade bill, which in a lot of our feelings caused the last Great Depression. So all I say to you is continue to do the job. I think we should stand back and reflect, wait and hear from you before we rush into any type of legislation, and give you time to digest what happened, but at the same time, we better start sharing a lot of that responsibility ourselves. Thank you.
Senator Sasser.
Thank you, Mr. Chairman. Mr. Chairman, the question that I've heard time and time again over the past 2 weeks is, in fact, I've asked myself that same question, is why did the stock market crash? We've heard various answers to that question. Among them, one of the reasons given are Secretary Baker's purportedly ill-timed comments regarding the interest rates charged by the Germans. Some say our action in the Persian Gulf. Others say the Fed's increase of the discount rate and the tight money policies that appeared to be in the offing. Some say it's the budget and trade deficits, although they've been around now for about 7 years or longer. And of course, there's program trading, and even one respected, well, I won't say respected, but one columnist advanced the thesis that the rejection of Judge Bork is really what caused the market to crash. Yeah, and I'm reminded that Secretary Weinberger says the defense cuts are what caused the market to plummet. But I think when all is said and done, Forbes magazine had it right when they wrote this week that the better question to ask is, how did stock prices get so inflated in the first place? And for Forbes, the answer is only too obvious. They say that prices on the market simply got out of touch with reality. Well, in August of this year, stocks were trading at a ratio of 22 times earnings, in contrast to the norm of 15 times earnings. And what our former colleague and distinguished investment banker Nick Brady terms an overvaluation, indeed a worldwide overvaluation of equities, had developed. And according to Nick Brady, rampant takeovers, restructuring, and stock buyouts financed with borrowed money were a major factor in the dramatic rise in stock prices. And Wall Street, I think, developed a casino atmosphere, a reputation as a place to get rich quick. It's been marked by excesses, the largest insider trading scandal in history. And 25-year-old people making 6-digit salaries and bragging about their role in restructuring corporate America. A market in stock futures that was growing to rival the size of the stock market itself. Now, Mr. Chairman, the warning signs of this collapse and the ensuing volatility were out there for a good while. And certainly our fundamental economic problems, such as the twin deficits, that of the budget and the trade deficit, have been with us for a good while. And for over 2 years, John Phelan of the New York Stock Exchange and others have warned us of excessive speculation and told us, to quote Mr. Phelan, that the markets are leveraged to the teeth, close quote. And what's been the response of the government to this warning? This administration has espoused a, quote, efficient market, close quote, theory. In other words, the stock market works best when it regulates itself, a hands-off policy. Somehow we seem to have forgotten about 1929. In effect, it was a green light for a nation that Business Week calls, quote, obsessively devoted to high-stakes financial maneuvering as a shortcut to wealth, close quote. What Business Week called, quote, a casino society over 2 years ago. And I think this hands-off policy had an impact. At a time of enormous increase in the volume and complexity of the markets, the Securities and Exchange Commission was left enormously underfunded. Indeed, the General Accounting Office has been sharply critical for some time of the Securities and Exchange Commission's underfunding and lack of staffing. The General Accounting Office has criticized the Securities and Exchange Commission's excessive reliance on so-called self-regulatory organizations to regulate the market, and the SEC's resultant lack of oversight of these organizations. And frankly, as I've expressed in the past to you, Mr. Chairman, both publicly and privately, I'm concerned about the laissez-faire orientation of many of the key securities regulators appointed by this administration. This hands-off attitude at a time of extreme volatility, speculation, and complexity contributed, I think, to the overheating of this market. The market pushed itself to greater and greater heights, to a point of unreality, where a precipitous and, I think, disastrous fall was inevitable. The markets, on balance, I believe, performed well, considering the enormity of the crash. But I think we need to look long and hard at the policies that got us to this point. And let's not kid ourselves. This fall ruined many small investors. I think as we peel this thing back, we're going to find that the big investors got out early Monday. And it was the small investors who rode that market down until late on the afternoon on Black Monday. And this fall may have irreparably damaged business and consumer confidence in this economy. Only time will tell about that. But I think, Mr. Chairman, it's our duty on the Banking Committee to make sure that we have a regulatory framework in place that will prevent another damaging fall. It's our task to do this job with or without the help of this administration and to try to help calm the markets and begin the process of restoring confidence in the economy. Mr. Chairman, I thank you.
Senator Graham.
Well, Mr. Chairman, thank you. Mr. Reuter, I welcome you before the committee. There is good news, I'd like to say. First of all, I hadn't heard anybody cuss Graham Rudman since the stock market collapsed. And I think it proves the old adage, it is a foul breeze that doesn't blow any good. Secondly, it's as if a great evangelist has come to Washington and saved many souls, and there are many born-again fiscal conservatives. Now, we'll get a test as to how much backsliding there's going to be when we finally quit talking about all we're going to do and the negotiators come up with a real program and we ask for the yays and the nays. My theory is a simple one as to what happened, and that is after 2 years of progress in reducing the deficit, in reducing the size of the federal government relative to the private sector, we had a fundamental change in expectations in the marketplace. People really believed, beginning in December of 1985, that for the first time in a quarter of a century, that we were going to do something about the deficit and about explosive growth in the federal government. Beginning in January and February of this year, spending took off. The projected rate of growth, unless we do something in the name of this newfound fiscal responsibility, the projected rate of growth in federal spending this year will be almost 3 times the rate of growth last year. I think that combination of increase in spending and the deficit, the fact that the Federal Reserve Bank clearly took its foot off the gas in January and February and applied it gently to the brake, the monetary base growing this year less than half of what it grew last year, and the fundamental reordering of expectations of investors as they looked at 2 years on which they had projected that success into the future, saw the current failure. I think a combination of all those things produced the high interest rates that produced the underlying problem. I frankly am amazed at all the talk about program trading. If by eliminating the use of the computer you can make stock prices high, I suggest you go on and outlaw the calculator and ultimately the pencil. If you could simply have people chisel these records on rocks and that would somehow make values higher, or outlaw written communications altogether. Just have people do it all verbally and have it committed to memory. I think it shows a sign of the kind of quackery and nonsense where we're blaming the technology of exchange for the problem which we have fundamentally created. Finally, this whole idea of laissez-faire and free enterprise is obviously a passing fad. We would have never had the collapse in the stock market without it. Of course, we never would have had any real equity value without it either. But I go back to remake my point, Mr. Chairman, and I'll yield the floor. I think there is something that Congress can do about this problem, and I think what we need to do is get back to the policy that for 2 years saw equity values grow, a policy that has created an economic recovery where 13.5 million people have gone to work in permanent, productive, tax-paying jobs. I think that policy changed in January. I think it's reflected in the current deficit numbers, and I think that's the one thing that we can do that will really address this problem.
Thank you, Mr. Brown. Stanford?
Thank you, Mr. Chairman. I certainly share the tremendous concern expressed by my colleagues about what has happened in the stock market, financial markets of not only this country but of the world, and I am pleased that Senator Regal is talking about looking now at the entire range of financial markets to see just where we are, because this market volatility that we've seen may very well have fundamentally changed our financial markets, or more likely make us aware of the fact that they've been changed gradually now over a period of years, and we haven't paid very much attention. I don't think there's any question that Congress needs to examine the causes of the market's steep decline, but I think less obvious, and I was glad that Mr. Sassa raised this point because I certainly thought it was obvious enough to be of importance. We need to ask us why it climbed to such overvalued prices in the first place. And a great many people were worried about that before it ever fell. And whatever the causes and whatever toppled it, the major reason that they fell is because they were overpriced. In your testimony, you talk about PE being up to 20 from 10. The speculators had taken over. And I don't think that we can say that the budget deficit has caused it. I don't think that the market sends us a message. Surely we'll be concerned about that and we'll use it as an excuse for something we already have done. But I'd say rather than the market sending Congress a message, Congress ought to be sending the market a message, because there's not any question that, that unrestrained and, more to the point, unrestricted trading has been the major cause, in my opinion, of overvaluation and subsequent collapse. and it might be expected. Now, there are just dozens and dozens of things that ought to be attended to. I quote the chairman of the New York Stock Exchange, who recently said one of the reasons for the volatility, tremendous volatility, is a large amount of capital created during the earlier years of inflation that's not been converted into tangible assets, but instead has been used in this wave of takeovers and buyouts. And that's a point that I'm sure you and I have disagreed on. Not only this point, but another one that ought to have been obvious to us all along was made last August, not after the collapse, but last August. Elliott Janeway continued to tell people to stay out of the stock market, but his reason was a concern that we had allowed regulation to get out of hand or to be neglected, and we had allowed all kinds of new devices that were aimed more at speculation than at providing capital for the industry and the economy of the country. I quote him, "The stock market inflation has its roots in 1976, when the Commodity Futures Trading Commission was persuaded to rule that securities futures contracts are commodities." Janeway goes on to claim that permitting the purchase of futures at margins below 10%, the margin allowed for purchases in 1929, has permitted the lure of racy thin margins on which to trade stock and bond futures. And I certainly appreciate your diligence and your conscientious approach, but I can't help but take this occasion, because we are talking about restoring confidence, I can't help but take this occasion to remind you of I don't need to remind you, I'm sure, the Wall Street Journal yesterday commented that maybe the new chairman lacked the toughness needed to bring order to a reeling securities market. Well, let me say, I hope you find that toughness. I hope we can find ways across the board, and not just by balancing the budget, to restore the confidence that makes the securities markets a reliable source of money for the corporate and industrial enterprise of America. I think it's gotten out of hand. I think the speculators have it. I think the investors ought to get it back, and we ought to help them. Thank you.
Senator Graham.
Thank you very much, Mr. Chairman. I would like to ask permission to assert for the record a full statement of my remarks, which include positive statements for Chairman Reuter and the very difficult task which he has before him. I would like to respond and comment on some remarks made by my namesake, the senator from Texas. Well, I am attempting to restore our good name, and particularly to comment to the fact that my spelling of the name is Scotch, and I think that one of the things that our nationality is known for is the production of good economists, and one of the aspects of that heritage of good economists is an understanding of human nature, and that society has a responsibility to provide appropriate constraints for the avaricious character which is inherent in the human animal. I believe that one of the issues that we have to appreciate in this current situation is that we have moved into a fundamentally different era, and the most significant aspect of that change has been the globalization of the economy in which we operate. And therefore, while there is certainly blame to be focused within the United States and on this capital city and those of us who occupy it, we must understand that many of our basic economic motivations are now outside of our own sovereign control. This, to me, requires a new role for sovereign governments because we are increasingly dealing in what are essentially political economic decisions relating to the relationships across national boundaries. When the fact that Europeans and Japanese decide to restrain their previous level of buying of our treasury notes causes a sharp uptick in the interest rates on long-term Treasury indebtedness, and that sends a chill through the marketplace, is an indication of how quickly decisions made outside the United States can affect our own stability and well-being. And second, as to the return to either a non-verbal society or one which relies on chipping on marble, a concern for aviation safety does not require us to expunge the names of the Wright brothers from our history, and a concern for the fact that technology has caused the ability to convert our markets, which are intended to serve as efficient means of raising and distributing capital, into the categorization which I think Senator Sasser appropriately gave it, a casino, is a real problem. There may be some socially redemptive value to having people deal in options futures on a non-existent number which represents the aggregate value of Standard & Poor's stocks. What that social redemptive value is not clear to me, and the case has not been made. Technology has allowed us to convert a capitals market into a daily, 24-hour, worldwide traded casino. I don't think that that is in the interest of our economy, and I believe that is the type of reform to which our regulatory agencies should address immediate attention. I look forward to hearing your remarks and the interplay between members of this committee, an interplay which I would anticipate will have many chapters to be written in the future.
Thank you, Senator Graham. Senator Dixon.
Mr. Chairman, as we look at operational problems on the securities exchanges, I don't think we should lose sight of the fundamental problem that must be resolved: the devastating trade and budget deficits that so threaten our economy and the entire world economy. We must demonstrate that the Congress and the President can work together to lower deficits. We must end the gridlock that will have added over $1.8 trillion to the national debt by the end of this fiscal year. I think we need a budget agreement now. I think we in the Congress have a responsibility to work with the President to achieve a compromise that will be larger than $23 billion and will cover at least the next 2 years. I believe the congressional negotiators, both Republican and Democratic, are willing to do what it takes to achieve such a compromise. As to any operational causes of market volatility, I hope we'll not attempt to rush to judgment before we have the evidence. Given the magnitude of the problems we have been facing, I think that both the stock markets and the futures markets have performed pretty well. I also think the preliminary evidence strongly suggests that the futures markets were not the cause of the 508-point drop in the Dow on October the 19th. I think we should look at index arbitrage, portfolio insurance, program trading generally, margin requirements, and all the other relevant operational and regulatory issues. I think we should familiarize ourselves with the operations of the stock exchange and the futures exchanges and the role each plays in our economy. I'm confident that this committee is not looking for scapegoats. Rather, I'm sure this committee will carefully examine all the relevant evidence and take only such action as is warranted by that evidence. And I look forward to the testimony of Mr. Reuter along those lines to help inform this committee.
Thank you, Senator Dixon. Senator Sarbanes.
Thank you very much, Mr. Chairman. Chairman Reuter, I hope that you will address in the course of your testimony the capacity of the Securities and Exchange Commission to address the developments that have taken place in the market. And by that I mean not only over recent weeks, but over recent years. There's, I think, considerable concern, first of all, whether the Commission continues to have the commitment to ensure through sensible and prudent regulation, a structured market in which people can place confidence and reliance that it is operating in a way that merits their confidence. Secondly is the question of the resources available to the Securities and Exchange Commission to do its job. We've had, in fact, the anomalous situation in recent years of having the Congress urging the chairman of the Securities and Exchange Commission to seek greater resources in order to be able to address developing problems, and the chairman resisting that. And I'd be interested in hearing from you your perception of the Commission's ability, if it chooses to do so, to adequately address the challenge that's before it. Now, the Journal yesterday had a chart. I'm not sure it's necessarily the best index to use, but of course it compares SEC staffing with New York Stock Exchange volume for whatever that index is worth. But it does point out the tremendous increase in market activity as compared with the resources available to the Commission to meet its regulatory responsibilities. And it seems to me, as the new chairman confronted now with this crisis, that this is one aspect of the matter that you need to come to grips with and not be hesitant about, and give us the benefit of your best view of the Commission's capacity to address the changing situations which have taken place in the market. Otherwise, I think there's a basis for grave concern that it is simply getting away from you, and that in fact that contributed to the problems that we experienced over the last few weeks. And if that's the case, it only raises even graver concerns about the future. Thank you, Mr. Chairman.
Thank you, Senator Sarbanes. Senator Dodd.
Thank you, Mr. Chairman. First of all, welcome, Mr. Chairman, here this morning, and let me raise just a couple of points, if I can. First of all, I think most of us agree, obviously, dealing with the deficit issue. If it was not a problem before, what happened 2 weeks ago, it clearly has become an issue now, and our inability to resolve that issue could, I think, without any question, have a negative effect on market behavior and performance. And obviously the budget summit, we have Senator Domenici here with us, and I know others are working as we sit here to try and resolve those differences. But it seems to me, and I'd like you to address, if you could, a broader question that Senator Sanford touched on, and others may have before I arrived here, and that has to do with the volatility of the market and how these capital markets, how well they're operating to serve what are two broader questions, it seems to me. One is capital formation. Is this really contributing to the kind of capital formation we should be achieving, given the fact that in recent days we've seen some primary issues that are about to be offered withdrawn because of the volatility of the market, and what that means, and secondly, how it affects, obviously, long-term economic interests of the country. Those are the questions. So when we start talking about what needs to be done to improve market performance, it seems to me we ought to be asking those questions in the context of how it contributes to capital formation and how it contributes to long-term economic growth. It was interesting, and I'd like to ask, Mr. Chairman, if I could, that an article written in 1984 by a Connecticut economist, Nobel Prize winner, Bob Tobin, be included in the record today. The title of it was on the efficiency of the financial system, and it was rather remarkable, going back almost 4 years ago and writing and talking about it. It could have been written yesterday, not 4 or 5 years ago, in terms of what he suggested might occur. And he, just to cite a couple of things he says in that, and I'll put the whole report in there, but I think it's rather interesting. Bob Tobin questions whether the market was really efficient in reflecting fundamental values, or simply just mirrored what the average investor believed the average investor's opinion to be, which is what I suspect many of us think had more to do with what occurred a few weeks ago than anything else. He also noted that professionals who bet on long-term fundamentals, while everyone else is engaged in short-term attempts to guess better than the crowd how the crowd will behave. And it seemed to me rather timely that's what some have suggested has occurred. I would add, Mr. Chairman, that the market in recent months and in recent weeks does indicate that many people, it seems to me, were engaged in what Bob Tobin referred to as kind of a speculation on the speculation of other speculators. And I'd like to have you address that question, you may, but whether that issue, obviously liquidity is a double-edged sword. We don't want people hiding money in mattresses, but simultaneously we want to make sure that we don't end up with so much speculation that capital formation is jeopardized. And lastly, and you may have included this as well, but I heard from a great number of my constituents who are in Connecticut, I suspect was maybe as a state harder hit. Don't know if any studies were done, but given the fact that we have the highest per capita earnings of any state in the country and the proximity to New York, I suspect my state was harder hit than any other by what happened a couple of weeks ago. But a lot of people suggested that this notion that was raised in the tax bill in the House side in terms of the limitation of $5 million on acquisition of debt, interest on acquisition of debt, scared the daylights out of a lot of people, that this was somehow this proposal in the House side had a tremendous effect on people getting nervous about the ability of the Congress to understand the importance of merger and acquisition. I'm just curious from you whether or not you believe that particular suggestion made on the House side, not included, I would add, in the Senate side at all in the tax bill, had as much of an impact as some people have suggested. And I thank you, Mr. Chairman.
Thank you, Senator Dodd. Senator Domenici, you've been extraordinarily patient. We apologize. As you know, we get a subject like this, and there are more than one television camera in the room. The opening statements are very considerable. So we apologize, but you go right ahead. And
Mr. Chairman,
you can
and
confine your statement to, say, 10 minutes.
I might even have to do shorter than that because I'm supposed to be somewhere else. I'm very appreciative of your giving me an opportunity to even appear here. What I would like to do, principally for those of you who are interested and your staff, I spent a little bit of time thinking about this and wrote it up, and I'm not going to have the time to deliver it, so I'm going to ask you to just consider it.
The fine statement will be printed in full in the record.
What I was going to suggest to all of you, and I don't want to be presumptuous, but you know, I listened and I think I could agree with much of what everybody has said. Clearly, I could agree with a great deal of what Graham on this side said and Graham on this side, but I'm kind of reminded of what Winston Churchill said once. I'm going to paraphrase him so no one will worry it's not a real quote, but he said there's nothing as exhilarating as being shot at and missed. I think what he really said is there's nothing exhilarating as to be shot at with no result, but we'd rather say and been missed. Frankly, I suggest to you that, first of all, we have a fragmented system. It's interesting that you have before you the SEC head man, but interestingly enough, you don't even have jurisdiction over that fellow that is chairman of the other entity over in Chicago that controls the futures, because you know, that started off with pork bellies, and so they had a big fight over that, and now they invented only a 5-year-old instrument that they have jurisdiction over that trades in the same market with the cash market, the stock market, the so-called derivative market that they've got. You don't even have jurisdiction over that. They have different rules. For those who don't think we ought to look at the rules, I submit to you that the whole marketplace that we're talking about is regulated, so I don't know that anybody ought to be so worried about a committee, if they really are serious, looking at the rules. I mean, there is no marketplace in either of these. There's a regulated marketplace in all of them, and it's changed so rapidly. As a matter of fact, the instruments, the index futures, are only 5 years old. They're an ingenious idea. All you need to do is read the papers in the last few days, and the New York Stock Exchange is pointing its finger at the futures market over in Chicago, and the Chicago futures is pointing their finger at the other direction. To me, that for starters, we ought to accept the admonition of Winston Churchill and say it's too bad that we didn't see an opportunity in these rapidly changing times to have a full-blown comprehensive hearing before we got shot at and missed. It's obvious to me, and I hope it's obvious to everyone here, that
we need to take a good, solid look at the entire spectrum. Would you believe that the Department of Labor is very much involved in what's happening? Chairman can tell you that. They have standards of performance that are out there that are absolutely binding on portfolio people who control pension plans, and they act pursuant to those standards, regardless of what's happening to the market. It ought to be obvious to everyone that the futures market has become larger than the stock exchange market. I have the numbers here. There's more money exchanged in the futures market than there is in the stock exchange. Well, so what, somebody might say. Well, they have different rules. They have different margin rates. Maybe they ought to, but maybe they ought not. I mean, there's a lot of money being made in just playing around between the two of those. Now we have whole new gadgets around. The portfolio insurance program, it faltered for a little bit during this 500-point drop. Seems to me that without going into all of the details, the issue is you can have bull markets in the United States. We've always had them. Bull markets, in this particular instance, rose to heights out of all proportion to earnings, went wild. So should we complain about it? I don't know if we should complain about it, but the issue is, if we're going to have bull markets and bear markets in the future, are we to expect that we're going to have bull markets and bear markets that are going to vary overnight by 100, 200, 300, or 500 points? Now, frankly, there will be some witnesses who are probably going to tell you that is the future. That is the way it's going to be. I really can't believe that. I can't believe that shouldn't get back to a point in time in America when you have bear markets and bull markets that go about their business relating to something, even if it's the psychology of growth or the psychology of optimism or whatever it is. But to sit here and assume that we should not take a serious look at the regulatory processes and see what we can do, not by way of recrimination. I mean, we turned loose the most innovative minds in the world under a premise of making money. And some people call that greed. Well, whatever it is, that's what we've done. And now we've got new instruments of finance. I have in my statement some of the most incredible, unique instruments of security that are being sold out there that you could ever imagine. They now have a security that they're selling that is somebody's automobile inventory. You can buy and sell those. Nobody would have even thought of those before. I'm not saying there's anything wrong with them, but it seems to me, rather than go through the details, how serious is it for our country with a $4 trillion GNP, let's just use that for starters, to suffer overnight a 1/4 diminution in the GNP of the country? That's one way to look at the 500-point drop. People will say that's only paper. Well, that's what everybody deals in, so it's become real. I mean, you will have no way of imagining the ramifications of this down into Main Street America. How do we know how many small businessmen, how many of their portfolio of collateral is no longer acceptable to a bank? And they're going to have an awful time. They may have to liquidate. They may have to do something else because it was worth one thing one day and another hugely different amount the next day. It seems to me that if you're going to conclude that living in a fragile, new international marketplace where things happen quick and new and ingenious processes are around, if you were going to conclude that the regulatory processes of another age are adequate to what it brings to play, then obviously you're going to miss the point. If we're going to use it to recriminate against fiscal and other policies that we can't affect here, then I believe we're going to leave unscathed an opportunity in a very intelligent and forthright manner with the assistance of experts in an orderly manner. We don't have to scare them to death. They can tell us the truth. Frankly, you could put them in a room, and between Wall Street and the Merc, if you could get them to talk to each other, they could give you a list right now of 10 things that are wrong, I'm sure, that ought to be fixed. I just pulled that out of the hat, but I'm positive that's the case, which would lend themselves to stability, not to trying to impose recriminations, but to stability in a very different marketplace than we had 15 or 20 years ago. You know, we had the great fall, and then we had a recession, and back there in the 29s, 30, 31, 32, and frankly, nobody complained about putting the margin rule in and said, my gosh, you're interfering with the marketplace. I mean, we had to do something. I mean, we found something wrong with it. Seems to me the same thing is the case here. I've listed about 5 things that I think ought to be looked at. I'm not going to go into any more detail, Mr. Chairman, but obviously we now have over in the Agriculture Committee, whether this august committee likes it or not, there's about 50% of the jurisdiction of the issue that had its beginnings in commodities that were unrelated to paper securities. And they won that jurisdictional fight, and they're almost bigger than the stock market. And so it's over in the Department of Agriculture because they had pork bellies, which was a commodity at one point. Now they've got these new kind of instruments. We've got the Department of Labor, we've got the Treasury Department, all of which set rules. Many of those rules may be part of the compounding effect that obviously cause things to come out automatic. I'm not here, Senator Graham, you were showing me a pencil and I didn't get the message, but I'm not here to quibble with the computer. If we can get faster ones, we ought to get faster ones. If we don't, the other guys will, and we ought to use them. But I don't think that's really the issue here. The issue is what are the rules of the game that you apply the modern instruments of trade to. And clearly there's one other new thing that's obvious. Everyone who watched that stock market knows it. There are 3 or 4 centers of stock market activity that are huge, and they're not in the United States. And they operate on a different time cycle, and that all contributes to this problem that we've got. I don't think we even had that in mind when we put most of these regulations on the books. I apologize for not being able to go into more detail with my analysis, but I thank you very much for the opportunity. And let me say, for all of the good wishes for a deficit reduction package that is significant and real, all I can tell you is we are trying, and it is far more difficult than any of you could really believe, because it's kind of a chicken and the egg. Who wants to agree to the tough things first and be the first ones out there because they're afraid, everybody's fearful that they will be blamed. But I'm optimistic that within the next few days we'll get a real package, and I thank you for your hospitality.
Well, thank you, Senator Domenici. Do you want to answer questions? Do you want to leave? You can do either one. We do have, as you know, a very distinguished witness. We'd like to get to him as soon as we can. On the other hand, if you'd like to respond to questions, we can maybe have 2 minutes for each senator or something like that.
I'm really already 15 minutes late to that summit that you all
Well, you better go to the
want me to
summit
go.
then. You can probably do more creative work there than you can do here.
Thank you.
Thank you very much for a fine
Maybe we
statement.
ought to keep him here. I don't know. What are you going to do with it?
Well, Mr. Reuter, you're also a very patient man. It's you've had to listen to our sage comments, and now we want to listen to somebody who knows what they're talking about. So you go right ahead.
Thank you, Mr. Chairman. I'm delighted to be here. This is my first testimony before your committee, except for the testimony that I gave in connection with my confirmation hearings. I'm delighted that I am now able to testify and that you had faith enough in me to confirm me. I hope that as the events of the next few months and years go by, that you will be increasingly satisfied with the fact that you have confirmed me. This is not only my first testimony, but to my knowledge, it is the first testimony, public testimony before Congress of anyone intimately associated with the events of the last few weeks. And for that reason, I consider it an important event, one which I hope can be viewed as the first step in a series of studies and testimonies. These weeks have seen, as you know, a record 508-point drop in the Dow, followed by 102-point and 186-point rises. But I might note for you that the week of October 5th saw us with a 158-point negative drop on the Dow, and the week of October 12th saw us with a 235-point negative drop on the Dow, and that during the days of October 14, 15, and 16, we had drops of 95 points, 58 points, and 108 points. So that prior to Black Monday, there was a significant decline in the stock market. I might also note for you, just for record-keeping purposes, that on August 12, 1982, the Dow was at 776, and that approximately 5 years later, the Dow was at a high of 2,736. So we have seen volatility over a 5-year period, I think, on the upside, followed by volatility on the downside. Certainly a strong and dramatic increase. These recent dramatic price declines have been broad-based, with the NASDAQ and Amex indices down over 20% since October 19, and all of the markets have experienced daily volumes that exceed all previous records. You should really be aware of this fact in analyzing what has happened. Prior to the week of October 12th, a 200 million share day on the New York Stock Exchange was thought of as being a large day. There had been only one day with over 300 million shares, and yet on October 15th we found 263 million shares. On October 16th, 338 million shares. And then during the week of October 19, we had volume which dramatically exceeded anything in the past. October 19, 604 million shares, roughly 3 times what was a normal high. October 20, 608 million. October 21st, 449 million, and October 22nd, 392 million. Those 4 days alone, on each of those days, you had volume exceeding any previous volume by an enormous amount. So not only are we looking at volatility, but we're looking at enormous volume changes. It's also important to note that in the foreign markets, we had turmoil during this time. The London and Japanese markets declined 33% and 17% from their 1987 highs during the October 19th period. Now, the Commission is deeply concerned about the impact of market volatility. I should tell you that my personal concern has preceded the event of the past few weeks. My first major speech as chairman was delivered in early October, and it was delivered in Chicago, and in, I think, a prescient manner, dealt with the problems of volatility in the stock market. You asked me during my confirmation hearings whether I would be hard on insider trading, and whether I would pay close attention to the problems in the takeover area. And I agreed, but my private agenda, after I came to the Commission, was to be concerned about this market volatility, both in the United States and as it extends abroad. Following the market volatility problems, we are beginning to commencing an immediate analysis of the recent market events. I asked my staff to begin that analysis during the week of October 19. We are beginning it. We were delayed partially during the remaining of that week and during the week of October 26 by market events, but we're still we are actively engaged in that study process. I have in my testimony, my written testimony, and I will in these remarks and in answer to questions, describe the Commission's oversight of operational and financial integrity in the markets during the past weeks, and I will set out some fundamental questions that our study must address and answer. I would like to answer interstitially, as I go through my prepared opening remarks, some of the questions which were raised by the various senators. I want you to know that the Securities and Exchange Commission is an independent, self-regulatory agency, and that we are committed, under my direction, to regulating if that regulation is necessary. I will, when an appropriate question comes, answer the question, deal with the question of our resources, but I do want you to know that during this past 2 or 3 weeks, our staff performed in ways which made me extremely proud, and that we had adequate resources to meet the peak demand requirements. I do not think, and I will indicate later to you, that we have the resources to conduct a study, to do the kind of contemplative thinking, and to go forward with our obligations that we would really like to have. So what happened during this period that we are concerned about? The Commission's expanded monitoring began on October 6th when the Dow dropped 91 points. That day, curiously enough, was the day of my volatility speech. Beginning on October 14, when we had the beginning of the last 3 days of declining prices, the Commission staff began on an emergency basis to canvass the various self-regulatory organizations concerning the financial conditions of broker-dealers. And then when we got into the last 3 days on October 14, 15, and 16, and it began to seem that the markets were declining precipitously, I instructed our staff to begin an emergency monitoring system. The senior staff of the Division of Market Regulation held weekend discussions to plan for monitoring. And on the morning of October 19, we began a series of telephone calls. And during that week, I was personally involved and my staff were personally involved in talking constantly with the various people who were involved in the regulatory process, both at the exchange level and indeed at the brokerage firm level. I personally spoke with John Phelan about 9:30 on Monday morning and learned about order imbalances. And throughout the day, our staff, and myself included, were in constant communication with the New York Stock Exchange to determine volume, extent of order imbalances, capital positions of specialists, and any operational problems occurring at the exchanges. Throughout that day, the staff was, as I say, in contact with major broker-dealers, and on Monday afternoon I spoke personally with 3 leading CEOs of brokerage firms, and there was enormous contact not only at the exchange and broker-dealer level, but with all other agencies, as I say, clearing agencies, options markets, mutual funds, order routing firms. And I can tell you that on Tuesday, Monday and Tuesday of the last 2 weeks, our commission was on what I would call a war room footing. We were really concerned and monitoring and acting, I felt, responsibly in cooperating with the other regulators to see that that matters were being handled well. Our significant activities, regulatory activities, which we took during that week, included various numbers of matters, including cooperating with the New York Stock Exchange in its curtailing of program trading, worrying about the New York Stock's very strong order imbalance crisis on October 20, that was Tuesday. They had almost 90 stocks that were not open during the middle of the day on that day. We cooperated with regard to the early closing of the exchanges beginning later in the week, beginning on Friday the 23rd. We worried about the liquidity problems of options market-making clearing firms. We cooperated with regard to increasing margin requirements in stock index options contracts. We assisted corporations in beginning their buying programs, which I think helped the market to recover somewhat, by interpreting our own Rule 10b-18 relating to the acquisition of corporations by their own stocks. And we dealt on an individual basis with both the various mutual funds and the mutual fund trade organization. And as I've indicated, in the near term, our staff will be asked to investigate the causes and effects of this volatility. And let me tell you what we're going to do, and it won't be everything we're going to do. First, we're going to address the role of index-related trading on the markets during the past weeks. And our preliminary information is that so-called index arbitrage and portfolio insurance activities were significant during the market downturns, particularly on the 16th of October and the 19th and 20th. When I say significant, I do not mean to quantify. I merely say that we have some indication that there was a significant contribution here. The study will also cover other questions raised by these events, including the adequacy of dealer capital to deal with increased volume and volatility. And I may say that I personally consider the question of adequate capital in our markets to be one of the crucial things which needs to be examined. We will be looking at the financial integrity regulations for our broker-dealers, their net capital requirements. And at this point, I would like to emphasize that based upon current information, including a conversation I had this morning with John Phelan, we still do not see any problems with the major securities firms. They are currently in a strong capital position. Additionally, we will be studying a matter which gave us great concern, and that is the market's operational capacity for order execution, order routing, and clearance functions. This is a problem which was difficult on the exchange, on the New York Stock Exchange itself. There were problems relating to the order execution capability by a number of firms using an independent processing agent. And we need to know whether or not there is a way, I'm not even going to say whether or not, we are going to insist that there be adequate routing system, settlement, and clearance functions in the future. We will also attempt to study the relationships between the various foreign and domestic markets during this period. And in particular, our study will determine the extent to which foreign capital was transferred out of our stock markets during the past week, during the market break. I may also indicate to you that the interrelationship between stock markets, foreign stock markets, and our domestic markets has been a matter of concern at the Commission and to me personally. I think it is part of a package which exists between our domestic markets and the foreign markets, that they have to be looked at together. And just after I came into office, I went down to Rio de Janeiro and participated in a conference with all of the securities commissioners around the world. We have been in contact with directly with the London administrators, the Department of Trade and Industry, the London International Stock Exchange, and the newly formed Securities Industry Board. And had I not had the events of these 2 weeks in question, I would have been in Japan on a long scheduled trip to talk to the Japanese about this market. The events of these last week, I think, have tested the efficiencies of our markets, trading systems, their personnel and settlement operations. I may say that we should all be glad that the systems and the industry handled this question quite well under the circumstances. We did not have a breakdown in the efficiencies of our markets. And I do remember this whole event is so impressed upon my memory. I had one telephone call with John Phelan on Monday morning, and he said, "Well, it looks like our exchanges are going to go. We're going to go to a $400 million share day." He said, "That will really test us," and they went to 2 $600 million share days, and were able to cope with that. I do believe that unraveling and analyzing the events of the past week should be and is my first priority. We will be cooperating with Congress. We're going to be cooperating with the Brady Commission, which has been established by President Reagan, and I would pledge my energies and those of our staff to advising Congress as best we can as to what needs to be done. I thank you, Senator Proxima.
Thank you.
We're going to take a short break from this hearing to bring you our regularly scheduled program update. We'll be right back.
You're watching C-SPAN, America's network. C-SPAN is a nonprofit cooperative created and supported by the cable television industry as a public service for its national cable television audience. In addition, C-SPAN is underwritten in part by the following.
Tomorrow's athlete. He's very much on our minds today as we develop new materials to improve the performance and safety of sports equipment. We're DuPont, a broadly diversified company dedicated to the discovery of better things for better living.
Well, we support C-SPAN because it makes sense. We're very grateful for the country we live in, the kind of government and process that we are all a part of. And C-SPAN does more than any other, I think, entity, provide Americans a way to follow that process, understand it, and appreciate it.
C-SPAN, created and supported by the cable television industry to offer unique public affairs programming to the nation. C-SPAN is America's network.
Yes. Chairman Reuter, for the last year, the president of the New York Stock Exchange has been warning about the possibility of what he called a meltdown in the stock market because of program trading. Now, by way of contrast, the SEC saw little or no danger. As Mr. Riegel pointed out, Chairman Shad recently said before this committee that the possibility of a 500-point drop in the Dow was extremely remote. It's now evident that the New York Stock Exchange had a much firmer grasp on reality than the SEC. I don't want to single out Chairman Shad or John Phelan. Obviously, you can't be responsible. You weren't in office when these judgments took place. But I think that their statements seem to reflect the institutions they represent. What I'm interested in is understanding how this difference in perspective came about. How did it happen that the SEC became so out of touch with what was going on in the market compared to the New York Stock Exchange? Did the Commission allow ideology to distort its view of reality?
Sir, as you know, I came to the Commission on August 7th, 1987.
As I say, I'm not asking your judgment compared with the Phelan. I'm just saying that the stock exchange itself and the SEC seem to differ on the possibility that you have this kind of collapse.
All I can do is to recite for you what I learned when I came in. Prior to my confirmation, I was briefed by the staff of the Securities and Exchange Commission, and particularly the staff of the Division of Market Regulation, briefings which would allow me to respond to questions here. I found that our staff was intensely concerned with this volatility problem. They spoke to me about the study that they had done regarding the market events of September 11th and 12th, 1986, with regard to volatility. They spoke to me about a study which that was a public study. They spoke to me about a non-public study which has been done about the events of January 23rd, in which we had 150 points or more of intraday volatility. They got into my consciousness with their concern about this. I may say they also talked about John Phelan's meltdown theory, and they described it to me in detail and told me what the possibilities were. And I talked with them and said, well, is this a likely thing? And they said, we don't know. And my response was, well, we better get going on this. We'd better get going on looking at the volatility portions. And I can tell you that the staff of the Division of Market Regulation has been concerned and has been on top of this. I cannot tell you what the commission, quote commission, has had as a view prior to this time.
Now, there's been some comment on your public discussion of possible trading halt on Black Monday. People say that frightened some investors into believing they'd have to sell quickly before the market was shut down. Deciding if and when to close the market, of course, is a judgment call. There can't be any quantitative parameters. But in your view, what are the various factors that would contribute to a decision to halt trading? Didn't halt it on that day. Well, under what circumstances would you halt trading?
There are essentially two reasons at two times in which one might halt trading. One time would be when there is a temporary order imbalance for reasons that are not very easy to identify, in which what you want to do is to cause the market, to allow the market to have a chance to see what the demands are. That is a very temporary, very small kind of trading halt.
Let me just interrupt to say my problem is why you, as chairman of the SEC, publicly made this discussion. Wouldn't it have been wiser, in retrospect, always easier with hindsight, to have made up your mind whether to do it or not and just shut it down without any prior announcement, or to say nothing about shutting it down? A rumor that I may shut it down, it seems to me, could have, and in this case may have had, contributed to the drop in the market.
Sir, there are many things that need discussing more than that, the events of my impact on the events of the day, but I will say simply that the media did not report my remarks correctly. There was a...
what did you say?
I said that, A, I had been in contact with John Phelan before I came over to give a speech, and B, in response to a question of what could be done with regard to a volatile market, I said, well, one of the things one might do is to have a temporary trading halt, a very, very temporary trading halt. Repeating, I may say, statements that I had made in my October 6th statement.
But in that context, wasn't that a logical interpretation by a reporter? You
I
say
think
one of the things we can do is a trading halt. In retrospect, would it have been wiser for you simply to say nothing about that?
Oh, absolutely. Yes, sir. I will agree with you. It would have been wiser, but under the circumstances, I had been in a speech in the middle of the morning, and I had not been able to observe what was going on in the markets, and I came out and was confronted with a bevy of microphones. And I really don't think it was in my consciousness that this was going to be the kind of down market volatile day. I would say one other thing I've learned, that apparently it was not the financial press that was out there. It was a different kind of press who may not really have been able to understand what I was talking about in this very crucial area.
Thank you. Senator Heiss. I heard chuckles from the press back there.
That was the network, Mr. Chairman.
That was the non-financial press.
The non-financial press.
On the other hand, I think that was kind of a comfortable chuckle. I think it came from the financial press. They're all for you.
I'm sure I'll hear about that remark also.
Senator Heiss.
Thank you, Mr. Chairman. Mr. Reuter, you said some things in your statement a moment ago, and you also didn't say some things which I'm quite fascinated by. You discussed financial integrity requirements, but you didn't indicate whether you felt why you felt there needed to be a careful look at financial integrity requirements. And what made me realize that you hadn't characterized any need is that I gather that as of today, firms may still not trade for their own account. Major investment banking houses are still precluded from trading for their own account using, I guess, either the direct order transfer system or the index futures or portfolio insurance, or all three.
May I just answer that question, then you could continue?
Yes.
I spoke with John Phelan this morning about that specific matter. They have removed an oral request from firms that they do not engage in proprietary trading in futures, so that they are permitted to do so. And as you know, during the last few weeks since October 20th, the use of the stock exchange's automated order system for putting in futures program trading has not been allowed, except at the opening. They are allowed to engage in use the automated system for opening, but during the day it's not allowed, and that still continues.
So that's still, now, why are you looking into the financial integrity requirements? Do you have reasons to do so?
Well,
do you have reasons to be concerned?
We're looking into everything.
Well, I know you are, but I'm asking you a specific question.
We had 2 specialist firms on the Amex and 2 specialist firms on the New York Stock Exchange, which ceased doing business during the events of last week. The major one was acquired by Merrill Lynch under a standby system which the New York Stock Exchange encouraged, so that the major firms stepped up to buy the positions of failing specialists. But I want to know whether the capital requirements for specialists on the exchange are strong enough so that they are able to conduct good markets.
Are capital requirements the same as financial integrity requirements?
Well, I think I put those into the same area. The financial integrity talks probably about whether the firm is going to fail. Net capital requirements are our technical regulations for how much capital you have. Excuse me.
Are you? Maybe I misstated my original question. In terms of whether firms traded put their own firm's interest ahead of their customers' interest, are you looking into that?
We are going to look into the a practice sometimes called front running. Yes, it's going to be hard to get information, but I want you to know that we're going to do our best to interview these brokerage firms directly to find out what they were doing.
You mentioned that on Tuesday, October 20th, 90 stocks did not open for maybe all day, but certainly for a very long time. Were those the stocks that were principally involved with portfolio insurance?
Of the 90 stocks that were not open during what was the crucial period, really around noon on Tuesday, approximately 20% of them were involved in the S&P 500 futures. Indeed, there were sufficient numbers of them closed so that the Chicago Board Options Exchange rule kicked in, which said we're going to close our options index when a sufficient number of our stocks are not available for trading.
Now, one of the things that you didn't mention in your in your oral statement, but you do refer to it on pages 19 and 20 of your prepared testimony, is the issue of margin requirements. You say the Commission will actively consider whether even higher margin requirements for index options and futures would bring these products more into line with stock margin levels while helping to reduce the leveraging that may be associated with derivative product trading. Now, the Federal Reserve sets margin requirements for stock purchases now, do they not?
For stock purchases, that's correct.
Why should the Federal Reserve not be the agency to set them for index futures and similar products?
I don't have a clear question about who should be the reserve setter. I do know that one wants to look very carefully at the difference in the reasons for margin requirements between the stocks and the derivative products, the indices. In the Federal Reserve sets its margins in order to be concerned about credit in the markets, and that comes out of the 1929 crash. The so-called margin requirements in the options index and the futures are more deposits in order to assure that that there will be the ability to pay. So we're dealing with a different use of this, and I think not only does one have to worry about whether the same organization puts in margin requirements, one has to worry about whether we need to look at the effect of not having credit-related margin requirements on the index products. But I don't have a position on that yet. It's one thing that needs to be studied very carefully.
Mr. Chairman, my time is spent. I'd just like to make a 15-second comment. Senator Domenici, in his excellent comments, made the point that we had been shot at and missed. Well, I don't know what it feels like to be hit if we got missed. What I worry about is that someone may reload and fire a larger caliber bullet at us with better aim. And if we are still talking about whether there should be margin requirements, whether there should be trading limits on futures, whether there should be other methods of dampening volatility, I think we're going to be splattered all over the wall unless we attend to that, which is why I'm going to introduce a bill this afternoon to give the Fed authority to set margin requirements. And anybody who thinks it's a good idea can join me, and everybody who thinks it's lousy can oppose it. But I think the Fed has shown they can do it for equities. I think they can do it in the other markets as well. Thank you.
Thank you, Senator Hines. Senator Regal.
Mr. Chairman, I have a number of things, and hopefully we'll have a second, maybe a third round here today. But I want to reconstruct a little bit the events on Monday, the 19th, and Tuesday. And let me start on Monday. Can you tell us when on Monday you first spoke with the White House?
Yes, I can, sir. Just 1 minute. I spoke with Howard Baker at 1:30 p.m.
1:30 in the afternoon?
Yes, sir.
Have you met with President Reagan since the 19th?
No, I have not.
Have you talked with him by phone?
Yes, I have. He called me on Saturday afternoon following the first week to ask me how things were going and to congratulate my staff on their excellent work, and I was pleased to have that call.
Have you tried to initiate a meeting like that? Have you thought it might be well to sit down with the President and sort of walk him through these things, or have you waited for them to call you? Or
No, I have not, but I have been in regular contact with various officials at the White House, and it's been my understanding that the President was being regularly briefed by Dan Crippen and Senator Baker.
So would it be fair to say that as of today, you've not yet had an opportunity to really have a substantive, detailed talk with the President about the issues that we're discussing here?
That's correct.
Let me go back to Tuesday morning. I think it's significant, as you've testified today, that coming down through the prior week, the week before the Monday when the market went down so dramatically, that the market had started to slide downhill, and you were quite concerned about it. In fact, you actually had set in motion a kind of an emergency team. I don't know that that was the phrase you used, but that you had become concerned enough about the pattern of events that you had put a special monitoring group together. Is that correct?
I'd asked Rick Ketchum, our Director of Market Regulation, to do so, yes.
So I take it that in that prior week, then, you were enough concerned about just the general tone of things in the markets that you were uneasy. Is that
95 points down, 58 points down, 108 points down in 3 successive days. Were unnerving, to say the least.
So your group was at work, if I heard you correctly before, over that weekend, in fact, leading up to the Monday where we had the major break in the market. Is that correct? Accurate? Coming through Monday's events and then coming into Tuesday, leading up to noontime on Tuesday, when there was this moment in which it was not clear whether the market system was going to be able to continue to function right then, my understanding is that, leaving aside for the moment the New York Stock Exchange, that some of the other exchanges had in fact shut down trading, that the Mercantile Exchange, in terms of their option pit, I think, closed at some point at or about noon. Is that right?
Chicago Board Options Exchange closed, as I indicated, apparently in result, because these 90 stocks were down. The Mercantile Exchange closed for about an hour at noon on Tuesday. I think the Chicago Board of Trade remained open, though. Yeah.
The Board of Trade remained open,
yes.
And they were continuing to trade their, whatever the index is that they trade that's derived from stocks.
That's correct.
I assume that the trading was, did it in a sense come to a standstill, or was that active trading?
Well, the major markets are the S&P 500 on the Chicago Merc and the option on the S&P 100 on the Chicago Board Options Exchange. So CBT really was not a significant player.
So the other two, though, had basically closed at that point.
That's right.
Now, when you indicate that there were some 90 stocks where there was this order imbalance and they were not able to trade at that time in the late morning on Tuesday on the New York Stock Exchange, were those stocks, were some number of those stocks Dow Jones average stocks that would be part of that index?
Yes, they were. I do not have the names of those stocks, but it's been reported to me that they were, yes.
So they were not secondary stocks, they were leading stocks. They were sort of...
well, as I say, 20% of them were in the S&P 500, and I think, I don't have an exact number, but a substantial number of Dow Jones stocks were down.
It would be useful for us, I think, to have that for the record. So we saw the jam up in terms of the inability to trade in some of the most well-known stocks and stocks that are right in dead center in the two widely monitored stock indexes. Is that
That's correct?
So that's where the trading, in a sense, had come to a stop. Can you tell us more about the anatomy of why there was that breakdown in terms of the ability for those stocks to trade? Why wasn't there some way to take and develop some match between buyers and sellers? What actually appears to have happened that caused the trading, in a sense, to stop in those 90 companies?
The New York Stock Exchange has a specialist system. That specialist system requires the specialists to make the other side of the market. They are charged with market continuity and market liquidity as functions in order to be specialists. And they have a monopoly system, so there's only one for each stock. Those specialists, during the events on Monday and the events on Tuesday morning, as we began to see a significant decline, were in what the street calls a long position. They had been buying, and there were lots and lots of sellers and not many buyers. And what had happened was that these specialists had now, as I understand it, had now accumulated very large positions in these stocks, and more were coming to be offered to them. And this phrase wasn't coined in this era, but the specialists do not have an obligation to buy the company. And they simply, some of them simply said, our positions are too long. The problem was not with one specialist having this problem. The difficulty was you had this 90 of them, and 90 stocks. They were probably specialists in more than, one specialist may have more than one stock, but you have 90 specialists, 90 stocks not opening, and you get on the floor of the stock exchange a certain kind of panic. And you must remember that that's a personal place. If you've ever been down there on the floor, it's even on a good day, it seems confusing. But I can only imagine what it was like down there that day when these stocks were down.
I'll come back. My time is up right now.
Senator Graham.
Mr. Reuter, did you ask the White House or the President to do anything they didn't do?
No, I did not.
Did you seek any assistance from them that they were not willing to provide?
No, sir.
Would you have had the President to do anything he did not do?
No, I think he performed well as far as
other than your statement to the wrong part of the media, and I have a hard time telling them apart myself.
One's green and the other's red.
Would you be careful about the color choice? Other than simply the problem where you were talking about options, and people obviously in the crisis at the moment took that as a live option, is there anything you think you could have done or should have done differently other than monitoring the situation, defining the problem, trying to set up a study to determine what should be done now that this horse is out of the barn to prevent another horse from getting out?
Well, on reflection, I think we should have had an emergency crisis plan available to deal with these matters. We did have an informal one, and that was that we would deal with. We were able to deal effectively with the New York Stock Exchange. I began during these weeks as well to have conversations with Kalo Heinemann, who is chairman of the CFTC. And during these next coming weeks, I intend to be in contact with him so that we can work out a combined regulatory plan to deal with the next crisis if it should come.
Now, when you talk about a crisis plan, could you just give us a very brief thumbnail sketch of what that would consist of?
Well, you want to do a great deal of monitoring. You want to be concerned, and again, I can't tell you exactly what it will be consist of until we know the facts, but you want to be concerned with the relationship, I think, between the futures and the stock and the underlying stock markets. And you want to be concerned with whether there are avenues for finding additional capital to come into the market. There are some technical things that one can do, relaxation of some of our rules, and urging other markets to do some things. We, at one point, urged the Chicago Mercantile Exchange through the CFTC to consider delaying their opening so that we would not have the relationships between futures and stocks displayed on in the New York Stock Exchange at opening. But I really can't give you a full plan for crisis since we haven't set it up yet.
Well, in terms of this study, are you going to do this study internally, or are you going to try to bring people in from the outside to participate in it? What are sort of going to be the parameters of the study?
We are going to use substantial numbers of our own internal staff to do this. It's going to mean that we're going to neglect some other things that we might otherwise do, but we will be doing statistical studying, interviewing, and contacting with both with exchanges, the other regulatory agencies, and the broker-dealer community itself. Particularly, we'll be in close cooperation with CFTC. We already have some data from them. We are going to use the New York Stock Exchange to give us data, and I've been in close contact with Nicholas Brady and Bob Grauber as executive director, so that they can do some kinds of interviewing that we can't. That organization, that commission is going to have, as I understand it, funds which will come to them on some sort of an emergency basis so that they can get a larger staff to go out and do some field work that we're not able to do with our own staff. So it's going to be a cooperative venture between all of the regulators and the Brady task force.
Let me ask you a final question as my time's about to run out. One of the concerns I've had in looking at what we might do, say, on margin requirements, and I differentiate between the rules of the game and the technology of exchange. I think looking at margin requirements, looking at the relationship between the futures market and the stock market, I think those are things we ought to be doing. I guess where I think we're getting out of the practice of economic medicine and into witch doctrine is when we start talking about actually trying to interfere with the transmission of information, the actual conducting of business. It seems to me that the illness, if it exists in the structure itself, is what is behind all that. What produces those decisions and allows them to be carried out at the risk of inadequate equity and other things, not the computer programming itself, but the system that allows that to occur. Do you agree with that or disagree?
Well, I don't exactly know the exact content of your question, but I think I can answer it this way. I think it's very premature to place blame on the futures market, on the way it operates, or on the stock market and the way it operates. And I think I agree that what we need to do is to look, is to avoid sudden activity and try to look very carefully at the futures market and the stock market. It is not altogether clear that one or the other is to blame if there is blame, and there are certainly good arguments to be made that the futures market actually added liquidity to our stock markets during this period of time. Something that may have been beneficial. So you don't really want to say we're going to close one in order to help the other unless you know that action is going to be the right one to take.
Well, Commissioner Reuter, I'd just like to congratulate you for a commitment to try to get the facts. In our business, it's always tempting to rush out and do something. I think it's very commendable that you have sought to get the facts to be sure that when you're doing something, it's the right thing, and I support that.
Thank you.
Thank you, Senator Graham. Senator Shelby.
Thank you, Mr. Chairman. Chairman Reuter, you've come from the academic world in Chicago to the marketplace in New York now. You didn't discern the difference between the press, I guess, or maybe you did, but some of us on the banking committee haven't been able to do that. You know, we see the press as the press, whatever they do, and a lot of them here cover financial matters, but it's hard to separate it from politics. You did use the word confused, that there was confusion on the floor. And I've been on the floor just as a bystander on several occasions, and there is confusion because the market is working there. But isn't it very important for you as chairman of the Securities and Exchange Commission to never be confused in any way, because the market to a great extent is driven by confidence?
I would hope never to be confused, although I'm not perfect.
Were you reacting? We know you're not perfect, but you're in a very responsible position now, and you well know this, probably better than a lot of us, but the market is driven with confidence. There's got to be confidence in the market.
Yes,
and if
sir.
there's not confidence coming from the chairman of the Securities and Exchange Commission,
Well, let me...
what happens then?
Let me put aside any doubts that you may have about my abilities to be an active and strong chairman during this period. I probably have more background in the market field than anybody except somebody who has been down in Wall Street acting in the industry.
This was all brought out in the hearings, and I was one of the ones that supported you, as you well know, not only in the committee but on the floor, and spoke on your behalf. And I recognize that, but at the same time, you're being tested under pressure now, extreme pressure, and when you come out with a statement that, or at least it was attributed to you, and you know, we're finding out what the word attribution means in politics these days, that you thought about putting a temporary halt to the market. Some people have written and said that that would have been a disaster. I'd like to hear your comments on that.
Well, I could only report that that there was a time on Tuesday when the markets were in a severely battered situation, and we were having conversations with the New York Stock Exchange and the Merc about whether the exchanges should be closed. And this was not initiated by us. It was initiated by the SROs, and the question was whether this was a good idea. And
excuse me a minute. Was your initial reaction to do a temporary halt in the trading?
I have to answer that in a more complicated way than I can.
Go ahead.
I started on the reasons why you might have a halt. The other reason for having a halt is when the markets go into what's called free fall. If you're going to have markets in which nobody is stepping up to buy, and no one's ready to buy, then you have to it seems to me you have to do something. But I will tell you that we never got to that position. The markets were strong, and they rebounded, and we did not close, and there was not a closing. And I would be very, very, very reluctant to participate in a closing of the markets under the kinds of conditions we were having on Monday and Tuesday. We were dealing with market demand. The forces that were coming out there were, and I must say I agree with Senator Proxmire that the markets were in a very much overbought situation, and there was an expectation of a reaction, and what you had was a more concentrated reaction than you might have had with tremendous pressure.
Mr. Chairman, let me ask you this question. With the Merc being basically regulated by the commodities futures trading, and the stock market basically regulated by the Securities and Exchange Commission, how are you going to be able to work with the stock exchange is going to be able to work with the Merc and so forth except by agreement or understanding?
We have no authority over the Merc directly. But,
it would take legislation to do that, would it?
It would take legislation to do that. We had an accord which resulted in legislation, but for the near term, I have to work within the regulation that exists, and I have established a good relationship with the CFTC, and I intend to be in constant contact with them so that we can work together if we get another emergency situation.
Lastly, my time's up, but I would like to touch on this. How are you going to work with the foreign exchanges? Tokyo, Hong Kong, London, and so forth. You can't regulate them. We have no power over them. How are you going to do it, and is it important to do?
Oh, it is absolutely very important to do so. I've already had personal conversations with Sir Nicholas Goodison, the chairman of the International Exchange, the London Exchange. My staff has been in contact with Sir Kenneth Berry, who is with the new Securities Industry Board, although it's not in full operation yet, and with other members of his staff, and we continue to, we were already in contact with them with regard to our memoranda of understanding in enforcement area. We have participated with them in several other ways. There's a technical committee under the International Organization of Securities Commissioners, which has been meeting together to deal with international problems, and we are going to continue along those lines as well as we can.
Thank you, Mr. Chairman.
Thank you very much, Mr. Chairman. Mr. Reuter, here is a copy of Business Week magazine entitled The Casino Society. And on the front of the magazine it says, no, it's not Las Vegas or Atlantic City. It's the U.S. financial system. The volume of transactions have boomed far beyond anything needed to support the economy. Borrowing, politely called leverage, is getting out of hand. And futures enable people to play the market without owning a share of stock. The result, the system is tilting from investment to speculation. Now, the interesting thing about this Business Week article is that this was written on September the 15th, 1985. The article goes on to talk about the problems of the economy, problems in the market, particularly leveraging. This is in this article, the head of the stock exchange, New York Stock Exchange, Mr. Phelan, says, quote, the markets are leveraged to the teeth. It talks about many of the things we've heard here today, highly leveraged takeovers, buying futures on the margin, program trading. At the time when this article was written, the Dow stood at 1,300. The article ends with a statement, and I quote, only when fear overcomes greed will the casino society rein itself in. The question nagging all concerned is how big a jolt is needed to alter the seductive calculus of speculation, close quote. Now, Mr. Reuter, did I understand you to say here this morning that the Securities and Exchange Commission has no crisis plan in place now and did not have one in place on Black Monday?
I think that characterization is not the right one. We had a crisis task force in operation, and we knew what to do during the events of preceding Black Monday. We were in operation. We did do what we needed to do. What we do not have is a new crisis plan based upon the events that occurred, and it's going to be difficult for us to know what crisis plan we should put into effect until we complete our study. We are doing some things. There are some, as I indicated, there are some things that can be done without a study, but we're not going to rush in to a judgment about what has to be done in a crisis, lest we accomplish more harm than we do good.
Well, let me ask you this question. As our nation's chief securities regulator, do you think we've had excessive speculation in this market? And if so, what's to be done about it?
I am not here as an economic witness, and I do not come to you with advertised expertise in the way the economy is running. I do note for you that the capital markets of this country play an important function. In order for our companies to go to the equity market and go to the bond markets to be financed, it's necessary that these capital markets be healthy. And one of my obligations is to be concerned that we do have a healthy capital system. But I don't think that one can easily state what is too speculative and what is not. One was not finding, I may say, a lot of criticisms of these markets when they were running from 1,200 to 2,700.
Well, I just pointed out an article written in 1985 that's highly critical of it in a major business publication in this country.
If you read the popular press, Senator, during the time between then and now, you were not finding a great deal of criticism about the market run-up. In fact, there was a great deal of thought that it was a proper run-up. Now, I will say to you that I am very concerned if we get into excesses in the markets. I believe that the credit requirements associated with margins are good. I have been in favor and continue to be in favor of the short sale restrictions on the New York Stock Exchange. As you know, you can't sell stock on a downtick. There are other things like that which I favor in order to remove excesses, but I can't make an overall economic judgment because I really am not here and do not consider myself to be an expert
well, just let me say
this,
Mr. Chairman, if I may. If what we haven't seen here is not excess, I don't know what is. Now, Mr. Reuter, in your confirmation hearing, and frankly, this is one reason I couldn't support your confirmation.
I understand that you couldn't support me,
Yes,
Senator.
you said you viewed the current takeover environment as, quote, a circumstance in which the shareholders of the target companies are receiving premiums over present market values of approximately 50% in many takeover situations, close quote. And you indicated that that was a very beneficial aspect of takeovers. Now, I'd like to contrast this, and if that's not speculation, I don't know what is. I'd like to contrast this statement with one recently made by Nicholas Brady. He said in criticism of takeovers, quote, let's not have drunk driving and speeding on our financial highways. We are, by saying there's no limit to what the shareholder can do to maximize wealth, ignoring every other part of the system, close quote. Now, as you may imagine, I happen to agree with Mr. Brady's statement.
I should imagine you would.
And I agree with him that excessive speculation in takeover stocks artificially inflated stock values. 22 times earnings they were selling for in August of this year. And I think that such stock values helped create an overheated market that was ripe for a precipitous fall. And my problem is that, among other things, that this fall hurt many small investors. And I think it could lead us possibly into a recession. And I think it's time, if the Securities and Exchange Commission doesn't have a plan, it develops one. If we sit here and let market forces determine what's going to happen, I think it could take us right down a path that we've been down before not too long ago.
I couldn't agree with you more, sir. I have spoken to that fact, and I've indicated that we are studying the facts, and among the other things that we're going to study is the question of whether takeover stocks led the market drop or not, an allegation that has been made. And I have told you that we are putting in place a near-term plan for dealing with volatility or problems if they should arise in the near term, and that based upon our study, we will be setting forth a longer-term plan which we think is advisable for the best of this country. And I say to you that I acknowledge that responsibility, and I will carry it forth to the best of my ability. Thank you.
Thank you.
Senator Graham. Thank you, Mr. Chairman. We are now in the period where the ground is still shaking, which is a time, I think, to see that we've got our instruments out, trying to learn as much as we can. It's not a time which is conducive to major change, but that opportunity for significant reform is going to occur immediately after the shock waves have receded. I think it's very important that we be prepared quickly to begin to evaluate what has happened and what changes are called for. In the context of that, when do you think you will be in a position to have some recommendations as to what administrative or legislative changes are appropriate in the context of recent experience?
Senator Graham, we are under a deadline which has been imposed by the President indirectly. The Brady Commission has a 30 to 60-day reporting time frame for its work, the Brady Task Force, and we are expecting to be in contact with them and to give them our preliminary observations, and indeed hopefully to go public with our observations by that time, which would be sometime in December. We will probably go another step after that and try to take their findings, and the New York Stock Exchange has a study by Nicholas Katzenbach, which we'll want to examine, so we may come forward with still another set of recommendations after the December report.
So you would say that by early in 1988, we ought to be in a position to look at your recommendations, the Brady Commission and the Katzenbach study?
I would hope so. I would hope so.
To continue the point that Senator Sasser has been underscoring about the movement from a capital market to a casino, what is the economic or societal rationale for the securitization of the index and then the use of that as a futures market?
I will respond to you, sir, with what I understand to be the rationale advanced by those that support that system, and that is that there is an advantage in a market to be able to sell and buy positions in that market in a hedged manner, so that if you feel you have too many stocks that you're too long, you can sell a futures product to offset your risk. Or on the other hand, you can buy futures and sell securities, so that you get into a risk transfer or risk prevention mode. That function has existed in the commodities markets as a means of providing a price stability and certainty, and that's the justification which is used for the derivative index products.
But isn't there a fundamental difference that in the traditional commodities market you were dealing with a tangible underlying asset? And you might actually get delivered corn or oranges or pork bellies or whatever it was, whereas here you're dealing with a non-existent statistical.
It's called a cash-settled commodity, and it is different. It is different. There is no obligation in the futures market for the underlying stocks to be delivered, and I think that's one of the things that we're going to want to look at, whether that difference is significant or not.
I'm pleased that you're going to look at that, and if you could also examine this, the rationale which you stated without necessarily endorsing have been advanced for this. What additional degree of liquidity, confidence is contributed to the market by having this new securities available as opposed to the maybe additional stimulation for speculation and volatility which it has introduced?
Yes, sir, and you should also know there's a fourth study that will be of interest to us. There are, the Chicago Mercantile Exchange has set up a task force with four leading, I guess I would characterize it, four leading economists without, and whom I have some suspicion will be supportive of of the Chicago Merck's position. So they should be presenting us with a rationale, which will be one that we can look at as another study input.
My time has expired, so just conclude with one further request. While you drew the distinction between your role as a regulator and disassociated yourself from being an economic theorist, you are in an especially advantaged position to assess the policy implications which underlie your regulatory function. So I would hope that when we meet in January to hear your report, that you will err on the side of being expansive rather than limited in your agenda of recommendation.
I should note for you that we have an Office of Chief Economist within the exchange, within the Commission, that we have a good group of people to advise us on public policy issues, and I will be using them, and also I will be relying upon other commissioners to come forward with public policy viewpoints.
Thank you, sir.
Thank you very much, Senator Graham. Before I call on Senator Carnes, let me just point out, Mr. Reuter, that before you testified, and this isn't your responsibility, but after our opening statements, the market dropped 28 points this morning, and after you testified, the market went up, so it's still down 16.75, so you've had a very salutary effect.
I could just make one comment that on the day that my nomination was announced, the market was exactly flat to 2 digits, one of the first times that there was absolutely no movement at all. You can make of that what you will.
Well, we need to flatten the market. I'm not sure that how I interpret that in this case. Senator Carnes, do you want to proceed? We have several senators, one senator who hasn't had his second round yet.
I just have one question, Mr. Chairman, if I could.
All right, go ahead.
Please.
You had your first round.
Chairman Reuter, you were quoted in the Wall Street Journal yesterday expressing your concern about the question of regulation of the futures markets by 2 agencies. Could you elaborate on that subject and describe what, if anything, would have been different, in your opinion, if the SEC had sole jurisdiction over the futures markets?
That's an iffy question. What I can tell you is that we are going to look at the problems that are created for regulation by having 2 separate regulators. We were not able to go directly to the futures markets to tell them what we thought might be an advisable scenario. And our inability to do that, I think, somewhat hampered our flexibility. And as I've indicated a little earlier, what I'm going to be wanting to do within the next 2 weeks is to develop with the Commodities Futures Trading Commission scenarios where we can cooperate with them in urging regulation of certain kinds of regulatory measures. The problem will come if we find that their view of what regulation should be is different than what our view of regulation should be. But I really can't comment on what those differences will be until we have an exploration.
Thank you, Mr. Chairman.
Senator Carnes, Senator Dodd.
Thank you, Mr. Chairman. Just a couple of points. I think many of them have been raised. One of the observations made, and I believe you may have made it yourself this morning in passing, and that is the efficiency of the market, the efficiency of the stock market that has been heralded. And I must say, I thought John Phelan did an excellent job, just as an observer during that period of time. I thought his public statements were first rate and contributed, I think, to, at a time of real crisis, some stability in the midst of all of that. But I'd like to come back to the efficiency question of the market, because it's one that sort of intrigues me in a sense. That stock markets reflect, if you will, the prices of various companies, the underlying strength, rather, of those companies. In fact, one of the arguments given by raters is that inefficient managers don't pay enough attention to the prices of their own stocks, and that's why you've had so much activity in the merger and acquisition area. And my question would have to be, in the question of efficiency, when you see in a shorter period of a time, as we did, drops in 25 or 30%. Is that an indication that those companies were really 25 or 30% less profitable than they should have been? Were managers that much less efficient, these companies? What does that indicate to you in terms of that whole, is the market really efficient to the extent that it reflects the strength of companies, or is it inefficient in reflecting that strength?
Well, Senator Dodd, I have never associated myself with the Chicago School of Economics and the theory that the efficient market is the true way to look at matters. I happen to think that there are always fundamental values associated with stocks, and that it may be that on a given day or given week or in a given year, the stock's quote real value is not reflected in the market. So it was my personal opinion when the Dow was at 2,700. It was my personal opinion that it was too high. I had investment advisors telling me that the market had broken away from fundamental values, and if one can put one's amateur hat on, my feeling was that the market was overbought at that time, and that there probably would be some reduction in market prices. What I don't think any of us really anticipated was that this drop would happen in such a volatile and short manner, in such a short time. And I think it's that question that we really need to look at with the greatest of care.
I raised an issue with you at the opening having to do with a question that's been raised. It's a narrow question, but let me raise it again with you, if I may. There's been a suggestion by some, I think more on the House side than the Senate side, having to do with the limitation on the interest in financing, debt financing for acquisition purposes. And I've been told by some that that had something to do with the panic, if you will, if you may want to use the word panic, but whatever word you care to use, that provoked some of the response we saw on October 19th. Would you comment on whether or not you think that's a wise suggestion that's being proposed as part of the tax package?
You're asking me to put my tender offer hat on, Senator Dodd, and you heard my exchange with Senator Sasser, or maybe you didn't, which indicated my disagreement with him as to the value of tender offers in the United States. It's been my publicly announced, presented views that if a tender offer occurs and shareholders receive value, that's good. The thought of quote killing tender offers by taxing, as I understand it, by refusing to allow interest deductions beyond a certain point, in my personal view, would be negative for takeovers, and therefore something that I would not personally support.
Mm-hmm. The last question I have for you is, there's been some suggestion, I forget, may have been the New York Times yesterday, may have been the Journal, I forget which, indicated that as a result of recent activity, that's estimated that as many as 50,000 jobs in the securities industry may be lost. Do you have any reaction to that particular comment?
Yes, I do. As you may know, there was considerable concern within the Wall Street firms prior to this drop that they had too many people and there was some effort to cut. But we're going to be looking very carefully at the clearance, the broker-dealer clearance and settlement systems, and if we find that their systems have not been adequate to cope with the high volumes in this market, and if as we must, we can expect there will be high volumes in the future, we are going to be, at least if I can have something to say about it, and I hope I will, be urging those firms to keep a back office staff which will be adequate to deal with customer orders and deal with settlement and clearance. So it may be that there is will be some loss in brokerage firm activity, but maybe we're going to see a shift in customer relations people to back office people.
Since I've raised the question of the employees of the private firms, how about your employees? We're talking about summit meetings and deficit reduction. There's Graham Rudman, a lot of other things kicking around. Do you see a need for an increased staff for the SEC to handle what you call an anticipated increase in volume? And if so, how are you going to get around some of these problems we face with reductions in spending in these various areas? And if so, how much of an increase would you imagine you'd need?
Well, that question is one I could answer either in a short. I'll start with a short answer, and if there's any further interest, I'll give you a longer answer. I think our staff needs significant increase. I have urged that in the '89 budget, which is the first budget over which I had any control. I am terribly concerned that the budget reduction talks that are currently going on are going to either at best allow us not to improve our staffing during 1988, and at worst cause us to have a reduction in staff. I think if that occurs, it would simply be a disaster for us when we are in a situation when we are having not only the demands of our current regulation, but demands of crisis regulation plus requirements of engaging in studies going on. So
Lastly,
I'm very concerned.
Would you call it dangerous?
Pardon me?
Would you call it dangerous not to have the increased personnel?
I'm in a peculiar position of wanting to say it's dangerous because I think that we need more staff, but wanting to say it's not dangerous because I have such confidence in the staff that already exists. I don't want in any way to suggest that we're not capable on a crisis basis or in a quality basis or even in quantity basis to deal with near-term problems. I do think that we need to have more staff for planning, more staff for studying, more staff for functions that are now not being carried out the way they should.
You'd appreciate, as I conclude here, my concerns that what you're suggesting is that we are in a crisis situation and you have an inadequate operation to deal with a crisis if it occurred tomorrow or the next day.
I do not think that if we have a crisis which occurs tomorrow or the next day that my staff will not be able to cope with it. We coped well during this last crisis, and we can cope again. But when we cope with crises, we are diverting staff from other objectives. For instance, regular broker-dealer examinations, which have to go on. So we need staff for many, many purposes at the Commission, and not just for crisis management.
I've gone beyond my time. Thank you, Mr. Chairman.
Senator Worth?
Thank you very much, Mr. Chairman. Mr. Ruder, welcome, and we're glad that you had a chance to come up. Let me ask you about some of the complaints that have emerged related to the fairness of trading on the floor during this crisis. Let me back that up by saying we all understand that the history of your agency and that the rationale for your agency is in large part to assure that investors believe that they are being treated fairly, that they have fair access to information, and that this is there is an equitable way in which they enter the market versus somebody else. There aren't unfair advantages that one individual or group has over another. Complaints have emerged, as you know, over the last week that individuals had troubles getting orders executed, but large operations, perhaps trading for themselves, in fact, have been able to execute their orders. Can you reflect upon the validity of that? Do you have enough information to comment on that? If not, how are you going to get a handle on that issue?
I don't have, as I've indicated, we don't have anywhere near the kind of information we'd like to have, but in that particular area, I can tell you of several factors which did influence that problem. The first was that in many markets, the telephone systems were not sufficient to allow calls to be answered by broker-dealers, and there needs to be some change there. On the New York Stock Exchange, the automated routing system was disengaged from the futures market, not only, I think, because there might be some problems with the futures market with the coupling of those trades, but because
that order routing system had to be freed up for smaller orders, for smaller customer orders, and that was done with an effectively to permit that to be done. A third factor which influenced the trading problems were that some of the smaller firms do not use do not have their own brokers on the floor of the stock exchange and can't call directly to the post to have their transactions executed. So what they have done is to employ a single vendor who then routes those orders through a linked up computer system and then back down to the floor. And we understand that there was some queuing at that single vendor, and we need to be able to be in a position to regulate, I think, the people that are providing those services.
It is your sense that over the last 10 days, particularly in the crisis days, the little guy was not treated equitably, the small investor?
Well, treated equitably implies some deliberate, some mental state.
Whether deliberate or not,
I think that
were the orders that a small investor wanted to have executed with as expeditiously as large orders?
My opinion, subject to more information, is that that was the case. Yes. That the small investor was not as easily able to get his transactions to the floor as was the large.
Let me ask you then a related question. If we continue to see this kind of volatility in the marketplace, 5% changes or 3% changes in a given day, and this kind of up and down, can we expect the small investor who isn't on the floor all the time, who isn't watching this happen, to continue to play in the market, to continue to invest in the market?
Yes, I think there are some small investors who will always continue to play in the market. I have publicly...
That's not responsive to me. The point that I'm making is the large investor is there watching it all the time. The small investor might say, hey, there's so much volatility in this, I'm going to back out.
That very well may be the case. I could imagine a scenario in which the small investor would say, I want to buy shares of a mutual fund, or I want to have my money managed by a professional manager who will be able to follow the market and do for me what I can't do for myself.
Let me say, Mr. Reuter, I think that one of the primary responsibilities that you have at the SEC as chairman, and that the SEC has, is to do everything you can to protect investors so that they are receiving a fair break. And I would hope that, I'm not suggesting you're not doing that, but I would hope that as you all are reading the tea leaves, going back and reconstructing what happened, that one of the priority attention might go to the protection of that small investor.
Don't you worry about that, sir. That's already high on my priority list. I would like to take regulatory action so that small investor did not feel that he or she was being forced away from the market. You asked me what they might be thinking now. Perhaps when we finish, they'll have more confidence that in high time...
Could I follow up on Senator Graham's question in closing? He asked you about derivative instruments, and in response to that, you quoted the justification by those who support the derivative instruments, and that you did not say what your position was. And I was wondering if we might
Well,
get your opinion.
My position, as reflected in the October 6th speech, which I referred to, was that derivative instruments do have some value in the stock market in terms of their hedging capabilities and substitution capabilities. I expressed concern in that speech, and I have even more now, that in times of crisis, high volatility, those benefits may be may not be sufficient there may be difficulties in the system, but I just don't have a firm answer at this point.
Your position has not definitely changed since October 6th, but it might have. Is that right?
I do not know whether... Well, it certainly is influenced by the fact that we've had high volatility days and high volume days. But I need to have facts before I can tell you that my position has changed. And we're looking for those facts.
My time has expired.
Thank you, Senator Worth. Chairman Reuter, I think you said that the stock index futures do provide a hedging opportunity for investors, and I'd agree if you said that, that's a prime economic justification for having the futures market operate. But didn't the so-called portfolio insurance break down just when it was needed on October 19th? Might investors have overaccumulated stocks because of the belief in the mirage of portfolio insurance, which turned out to be a mirage?
Senator Proxmire, I think that theory is one which we very much want to investigate. It very well may be that the institutional investors were oversold on portfolio insurance, believing that they could use this insurance to hedge against market losses, and that it very well may be, and I'm choosing my words carefully, it very well may be that as a result they overbought, and that as a result that they then found they couldn't get out as fast as they wanted. So we're going to look at that theory. Hasn't it been
established as a fact? Do we have to take days or weeks more to investigate it? Wasn't it a fact that they simply couldn't get that hedging insurance when they needed it the most?
That's been reported in the newspapers, but I have to tell you that I don't always believe what I read in the newspapers, and I need to know from sources, and we are trying to get exact facts from both the CFTC.
Well, I respect that greatly, and yes. you have probably the outstanding organization in the country and in the world, perhaps. It's got a great reputation, a deserved reputation over the years. Seems to me that you should be able to get that information in a matter of 24 hours. It's now been 2 weeks since that crash took place.
One of the things that I want to look into is our ability to get reporting information from broker-dealers. I want to, and I will be insisting, that systems be set up so that we can learn what kinds of trading they're doing. We are not able at this point, at least it's my understanding, to get quick responses from broker-dealers as to their use of various systems. And we'll cooperate.
I beg your pardon. I'm just going to say that the stock index futures are a relatively new development, are they not?
Yes.
And if they had not been available at the time of the market crash on October 19th, would the crash have been as sudden and severe in your judgment?
My preliminary judgment is that the stock index futures did contribute to volatility to some degree, and I cannot tell you how much.
One alternative to abolish them?
That's an alternative, but I certainly would not be urging it.
Well, we had years of experience without them, without the kind of enormous drop we had. Is it worth having something that we're not sure whether it's a mirage or not? It may not be sure for a long time to come.
Senator, I was concerned about foreign markets, as I indicated. We have been in contact, for instance, with the Japanese securities markets as to whether or not it might be possible for the Merck to open a trading on the so-called Nikkei index, and that's an indication to me. And the Japanese have indicated some desire in to engage in that kind of trading in their own country. And I would be very surprised if we closed our futures market if there was not the establishment of a futures market in a foreign country based upon U.S. indices. So one gets worried about, in the new regulatory climate, about whether our regulations here will have the effect of forcing activities overseas which we can't regulate. And I would like to be able to regulate those activities rather than to force them into some other climate where they're not as well regulated.
Now, Senator Heinz and Senator Wirth have both asked about this. The allegation that large securities firms placed trades for the accounts of firm executives prior to trading their client accounts. And I'm not going to ask you a question on it, but would you provide for the record the trades made by the major firms between October 15th and October 22nd, so we can, the committee can examine that?
When we have that available, sir, we would be very happy to do so.
Thank you. Let me ask you, has the Federal Reserve performed well as the lender of last resort during this crisis, in your opinion?
From what I could tell, they did. We were getting reports, and we were in contact with the Fed, And we were getting reports, and I don't have them very well substantiated, but that the Fed was encouraging their member banks to step up and loan funds to the broker-dealers who might be having problems.
And as far as liquidity was concerned, was that prompt enough, adequate enough under the circumstances?
Well, we did not have an ultimate breakdown of the market, so I have to say that it was.
Thank you. I see my time's up. Senator Hines.
Mr. Chairman, thank you. Mr. Reuter, on a couple of occasions today, you have discussed some of the reasons it was necessary to suspend trading in certain stocks at certain times. The system worked pretty well, I guess, but I've heard complaints from people on Wall Street that there is a fundamental problem, which is that the exchange is not geared to anymore to create an orderly market once you get over 200 or 300 million shares being traded a day. They don't say that the direct order transfer system can't do it. What they say is that the specialists at each trading station, which you described as confusing on the best days, simply cannot handle all the stocks that they are responsible for, and that there either should be far more specialists per station, or that each specialist should handle far fewer stocks. I didn't hear you touch on either of those questions in your testimony. Didn't see it in your prepared testimony. Do you have a point of view?
Yes,
are you looking into that?
Oh, definitely. I think that the market-making system, both in the exchange system, in the option system, and in the over-the-counter system, needs to be looked at to see whether we have sufficient responsible people who are willing to make markets, and to see whether they are sufficiently well capitalized. And that's really what we're talking about when we talk about whether we have a single specialist or several.
And how about whether there are enough of them?
Well, interestingly enough, the thing that happened in the New York Stock Exchange was that the failing specialists were acquired by the larger broker-dealers with large capital, and when you have a sufficiently well capitalized specialist and a specialist that's willing to provide the function of maintaining market liquidity, you'll have a successful system. Whether there should be competing specialists or not is an entirely different question.
I'm not asking whether there should be competing specialists. I am simply concerned that, and you and I have both been down to the floor on not together, but we, as you have several people clustered at a station, all dealing at the same time on behalf of a specialist for a lot of stocks, and it is inherently confusing. And sometimes I wonder how all the people who work as specialists together as a unitary specialist, even though there are many people, how they can keep all of that under control. But you're going to look into that.
We're going to look at, and I think it's an excellent question.
Let me move along to a second question. You touched on earlier I think Senator Graham of Florida asked you a question about, started to ask questions about what was really happening conceptually when, through stock index arbitrage and portfolio insurance, certain investors sought to hedge or eliminate risk and even lock in gains. Now, I guess my question is, if the trading exchanges, whether it's in Chicago or New York, are composed largely of transactions, the purpose of which is to eliminate risk from the market. And over time, large volumes of these kinds of transactions take place, and people hedge the cash market with the futures market. Something odd has really happened, maybe, to a market which is a vital characteristic of a market, namely risk, has been removed from the marketplace. Now, it may have been transferred someplace else, but a market that operates, in a sense, without the discipline of risk is a very different creature from markets that have been regulated in the past. And I'm wondering how you're going to get at that conceptual and theoretical question.
We're going to look at the two markets as though they're one, I think, is one of the investigatory methods we're going to use, and ask whether there, if you look at the two markets as one, there is indeed risk elimination in answer to one portion of your question. In the futures market, the theoreticians talk about risk transference as one of the functions. And I don't think one can start with a proposition that we're dealing with risk elimination in the stock market or pure risk transference in the futures market. But we need to look at the two markets as though they were linked in order to see what the characteristics are for that single market. And I really want to have an open mind as to whether we try to link them physically or whether we say let's cut them apart so there is no link, or whether we continue somewhat the way we are. Those are very important theoretical and conceptual questions which we're going to have to address.
If I may ask one brief question, and I will cease and desist, Mr. Chairman. You indicated earlier that you felt it was important to have a better emergency crisis plan on the shelf and ready to go. Let me try you with a crystal ball question. And you have a magic crystal ball as chairman of the SEC that you can consult any time you're in doubt as to what the market is going to do. And but it has a problem. It only reads 6 months ahead of time, which isn't bad. But you have to consult it every day to know what's going to happen 6 months later. And you look into your crystal ball and it says everything bad that you can imagine is going to happen. It says prepare for for the kind of psychology that brought about the 508-point drop. You know, the Germans are going to increase their interest rates. The Japanese are going to a value-added tax. The Fed is increasing interest rates. The bond market has fallen out of bed. It will fall out of bed. The Congress just passed a $100 billion supplemental appropriation. All this on some Monday 6 months in the future. And you can throw in a few more, leading indicators as well. Commodity prices skyrocketed today. Inflation is just around the corner. And you say, oh my God. But the good news is I've got 6 months to be ready for this. What are the first three things you do in your crisis plan? What do you do about margins? What do you do about some of the other suggestions like trading limits? What do you do about index arbitrage, portfolio trading, direct order transfer?
Well,
or do you want to take the fifth?
My answer is, of course, as you might expect, that I can't give you any firm answers until we have done an analysis of what happened in this market.
I understand that whatever answers you give me would be either hypothetical or theoretical. I'm asking you today, based on just a rough sense of what you'd have to do if this materialized out of the blue tomorrow. But you got the advantage of 6 months, and there's some things you can kind of do.
I would want to look at the margin systems. I would want to look at the order routing systems. I would want, most of all, to see what steps could be taken to increase available capital. I do not think that we can ever be in the position of saying that the market's only going to go up. We must expect it to come down at times. What I think we need to guard against is the volatile downside activities. And to me, the most important thing will be to find a means of assuring that there's sufficient capital to step up to prevent this unnecessary volatility. And I don't think, by the way, that that's a solution which is just one that the Securities and Exchange Commission can be with. During that 6 months, I might very well be coming to Congress or going to the White House or going elsewhere, going to the Fed, to try to talk about what things might be done to be in that position.
We look forward to seeing you.
You would.
Thank you, Mr. Chairman. I appreciate that.
Senator Hines. Mr. Chairman, let me say I think you've been very candid with us and very frank today, and I appreciate that. You've just come into this job. You've come in at a very difficult time. You and I have talked a number of times over the phone and in person during this period since this stock crash has occurred, and I've found you and your people to be very hard at work, focused as far as I can judge on the right issues, and I think your statement today, which has not gotten much attention, is, I want to say again, I think is one of the best I've seen in the 21 years I've been in the Congress. So I appreciate the hard work that's being done.
Thank you.
And I realize that it's we're into a situation here that is new and different and threatening in many ways. And so working our way through it, I think, is going to require cooperative efforts all around. And so that imposes a burden on all of us, I think. Let me make a couple of comments here, and then I want to pose a couple of questions to you. I think it's clear, and you've gotten this from the tone of the questions of members today, that this stock market crash has been very damaging in many ways. It's cast a long shadow over what our future economic growth may be. There's been a lot of fallout already. A lot of people have been hurt. Big investors have been hurt in a number of cases, but there are a lot of small investors that have been hurt. I know of cases like that. I'm sure you do as well. And I think one of the lessons at this stage of the game, when it's not precisely clear what the future holds, is that I think small investors have to be very careful and very cautious, because we're in the midst of a turbulent situation. You have said yourself there are a lot of studies underway. We don't have all the answers yet. It's going to be some time before we have them all. Adjustments that we may see that need to be made will presumably be made in due course, but I think until that time, I feel some particular concern about the question of people taking substantial losses that are not in a position to do so. I just want to say that at this point, because I think until the picture ahead is clearer, I think the people that really can't afford losses have to be extraordinarily cautious and careful. Now, a couple of things seem obvious to me, and I'd like to see whether you agree or not. It seems to me that where we stand today, some 2.5 weeks after the break on that Monday, is that the financial market system today remains fragile. It remains vulnerable. That's my impression. Would you agree with that?
I would not use the word fragile. I think that what we have seen is a financial market system which was able to accept the events of the 19th and subsequent events, and still is functioning well. We are seeing a market which is working. So well, I say that it has difficulties, but fragile is a little hard for me to say.
I would just go back to something you said earlier. When we came within an eyelash or something close to it, to perhaps closing the markets on that Tuesday, I think that connotes a very fragile situation.
I could agree with you under that condition.
And if I put the question a different way, and that is going back to some of the things that Senator Hines said earlier, should we, and let's hope we don't see it, but should we experience anything like another down day and where we saw an erosion of value in the Dow Jones average of anything close to 500 points from where we are today, the impression that I have is that would impose a new level of structural damage that I don't think it would be healthy for us to experience or to have to cope with. And Would you share that view that it's important for us to avoid another drop, anything on the order
yes,
of what we've had
sir. I think if we found another 500-point drop in the market, we would be looking at an even different circumstance and more serious one than we have today.
Well, and I raise that not to set off any acute sense of alarm, but rather to focus us on the fact that we've got some work to do. And I think we've got to move a lot faster than we are. And I address this comment now not so much to the SEC, because I think you're working as hard as you can within the limits of what you have to work with. And frankly, you are understaffed. You were very delicate in terms of how you said it today, and I appreciate that fact. But here we sit with the Graham-Rudman automatic cutting mechanism coming at us here in the absence of any kind of budget package would actually reduce the size of the SEC staff now unless we were to take some clear step to prevent that. That's to prevent a reduction. In fact, I think we need a substantial addition, and it should be noted that the SEC pays for itself. You have a user fee system where you actually generate a profit for the government in terms of billing out your cost, so the notion that somehow we're saving money by squeezing the SEC down in its staff resources, I think, is the height of foolishness.
Sir, last year our revenue was $263 million and our budget was $114 million.
Well, that's exactly the point. And so the notion that somehow we save something by squeezing the SEC down to a smaller and smaller size at a time when we've had all of these market developments, I think the markets have been tested in the most severe way since the late 1920s, that we've got to have the staff here. Now, I want to make one other observation here that does not relate directly to the efforts of the SEC, but they are the backdrop against which this whole situation, I think, has to be assessed. I think we've got a serious problem here of presidential disengagement from these problems. Now, when you indicated to me earlier in a direct question that you have not yet met directly with the President since this market break of 2.5 weeks ago, I find that an astonishing fact, and it's a disturbing fact. The Brady Commission doesn't exist yet. The crash happened 2.5 weeks ago. The people of that commission haven't even been named, and the thought was that we would have something done within 30 or 60 days, and we don't even have a working group that's underway as yet. I don't think there's any excuse for that. There's been no executive effort to beef up your staff. You're under these tremendous budget pressures. Your people are working 7 days a week. You're shorthanded, and despite the fact that your people, I think, are doing all that we could ask them to do under the circumstances, I mean, they're not made out of iron. They need help, and you should be offered help. And the administration should be, in fact, giving you the kind of additional help that it's clear to, I think, every outside observer you need at this point. The budget task force that's meeting, that Senator Domenici went to join, is certainly not making measurable progress that one can see. The days are ticking by. The only meeting that I understand that the President attended was the first day. It was sort of a ceremonial participation, has not been involved since. I'm not sure we're going to be able to get hold of things the way we need to if we're going to have disengagement of that sort in the most important office in this country. And I say that to everyone who has a serious interest in stabilizing this situation. We need all the confidence builders we can get right now. And we need more than we're presently getting. And we're seeing that in terms of this turbulence in markets around the world. And I think unless we can show a demonstrable tightening down of specific steps here, if there's any continuing sense that we're going to drift along here without nailing these things down and moving as fast as it's possible to move, I think confidence could turn against us. And I think that would be an enormous danger to this country and to the world financial system. I think we're in that risk situation now. I don't think we should accept it. I think if any of us who have any part to play, large or small, show a willingness to accept it, I think we're failing in our responsibility to the public interest. I think this situation is not over. I think it's deadly serious. I think every hour and every day that passes is an important time for us to use. And while I appreciate the effort that you're putting in at the SEC, and I think you're working to the limits of what you have to work with, you need help from other directions, starting with the President, his administration, and the Congress. And we need to be moving in a way that frankly, we are not at the present time. And I just, I am very concerned that we may find ourselves tested again because of confidence factors or market psychology before we, in fact, are ready to deal with it. And if we were to get hit again, coming now from this situation, rather than where we were 2.5 weeks ago, it poses an entirely different kind of danger. It poses a different kind of danger to the structure. It poses a very different kind of danger to people who could sustain windfall losses that I think in many cases can't afford to even think about having them. And there's no reason to leave the country in this kind of a risk position. So I am hopeful that one of the things that can come out of this hearing today is the fact that by getting the focus on these questions, we can begin to get a serious application of effort by others who I've enumerated here, way beyond what we've seen today. The clock is ticking. We're 2.5 weeks down the road, and a whole host of steps have to be taken right now that have not been taken. So hopefully we'll see some action in that regard. I don't know if you want to make any comment. If not, I'm going to yield to Senator Carnes.
I've had enough time, I think, to talk.
Senator Carnes.
I would like to follow up on Senator Riegel's comment, and you may have, I apologize for getting here late, and you may have already addressed this adequately, in your opinion, in your statement or in other comments to members of this committee. However, I would like to specifically ask if you would wish to make some recommendations, in addition to what you've already stated, to this committee, or as to what Congress should be doing, if anything, at this point in time. I think Senator Riegel's statement and the statements of my colleagues underscore very clearly the concern that many of us have. Yet, I think the reason for a hearing of this nature is to one, get information, and two, seek some counsel to a certain degree. And do you have some things that you would like to leave with us in addition to the I think, vitally important information that you've shared with us already about the staffing needs of the Commission? And I respect a great deal the comments of Senator Riegel regarding some of the other people in the administration and other people in and out of financial institutions in the financial marketplace that probably should be taking this situation of the last 2.5 weeks with a bit greater caution than just business as usual. So if you have not adequately had the opportunity to maybe change your hat a bit and consider yourself coming up on the other side of this table, and what would you be recommending if you were in that situation?
Well, I have indicated that my basic position is that we want to study what's been going on. We want to get more information from the exchanges and the CFTC. We want to see what kinds of information will come out from the Brady Task Force. We want to hear from the Katzenbach New York Stock Exchange study and from the four-scholar Chicago Mercantile Exchange study. And at this point, I am very reluctant to make any judgments about where we'll be going. It's not to say that we won't be making judgments and won't be making recommendations, but it's simply too early to do so. We have a very extensive study program underway, and we can identify certain problems. Now, whether we can have enough information to recommend solutions, I think really is something that has to wait until another day.
Thank you, Mr.
Thank
Chairman.
you, Senator Carnes. Senator Wirth.
Thank you, Mr. Chairman. We have coming up at us on the 31st of March the end of the moratorium, which means that we have time between now and the 31st of March to make some very fundamental decisions on the law which regulates not only the securities industry but banking's relationship to that, commerce, insurance, and so on. Given that very tight time frame, and given the last 3 weeks, what have we learned in that from the last 3 weeks what lessons have we learned that we should apply to our thinking on rewriting Glass-Steagall, if we should do anything at all?
We were in the middle of preparing our Glass-Steagall testimony before this crisis hit, and our effort was to look at the look at the Glass-Steagall problems to see whether if Glass-Steagall were repealed, we could have an adequate series of recommendations for Congress. We had not yet reached a policy position at the Commission as to whether or not Glass-Steagall should remain. I think what we did see in this last situation was a clear need to examine the interrelationship between the banking system and the security system, first with regard to the question of whether adequate capital can be made available to the securities industry, and secondly, as to whether or not securities industry, whether or not ownership by banks of securities industry firms would impose unacceptable risks on the banking system. I think those are issues which need to be looked at in great detail.
Well, let me ask you, if you were in the process of drafting your position, then the crash occurs, when are we going to get from you your position on Glass-Steagall?
Whenever we are called to testify, we will have it.
Well, we would presumably ask you when you're ready with that position. I mean, you said you were in the process of doing it.
Well,
I'm not being obtuse. I think you are a little bit. I mean, when are you going to have your recommendation
Well, as I say, we wanted to do two things. We wanted to draft the testimony, but then I wanted to go back to the Commission to get a Commission position.
Well, how long is that going to take to get a Commission position?
Depending upon how much the market problems get with us, I would presume that we would be able to come to a Commission position by mid-January, something like that.
Hey, let me remind you what the calendar looks like. I mean, if I don't have a Commission position until mid-January, that gives us the grand totals of the month of February and the month of March to rewrite an enormously complex piece of legislation. Do you think that's possible to do that?
I don't know what the Congress's crisis management plans are, but I am willing to say that if you want us to accelerate that schedule, we will try to come back to you in early December, if that's what you need.
Well, I'm not the chairman of the committee or the subcommittee, but it seems to me that looking at the time frame, it's going to be very, very difficult to do in any case.
I agree. It's hard to go from reports to legislation.
So therefore, isn't it realistic to perhaps ask you all to get back to us, sooner rather than later? I would think, Mr. Chairman, that would be something that we would want to do.
I think. What was that date? We had an earlier date to be with you. I was trying to get the exact date, but we can do, if you wish, we can work towards a early December deadline. Congressman Markey gave us a December 1st deadline, which I think may still be with us, although I haven't spoken with him recently about that.
Would the Senator yield just for a moment on that question, because it is a matter of great interest to us, but I think at the same time we have to acknowledge you're in the midst of honest-to-goodness crisis management here. You at least have been over the last 2.5 weeks, and there's also the unresolved issue of the definition of insider trading. We've got a number of issues that we're involved in trying to resolve. So given the additional problems of all the market turbulence and sorting through all that, which we've also asked you now to do on a priority basis to reconstruct what happened, I can see why it will really strain everyone to do that. Although I think at the same time, Senator Worth makes a good point. If we're not going to get a clear recommendation, or if the Commission's divided, and if it is, by the way, I hope that we'll be told that, it's awfully hard for us to crank that into our considerations.
We'll try to strain different people. I guess that's all I can tell you, that if you ask us to do that, we'll try to use different people who are not involved in our market studies.
I mean, first things first in all of this. Yes. I mean, I think that, the current situation obviously demands, your attention and that of the other commissioners and your best people, and that's as it should be. The point that I was trying to make is to identify a very difficult time frame at best. And maybe what we should just do is to be realistic about this and extend the moratorium. I mean, I know that sends shivers up the spines of all kinds of people, but reality from 2 weeks ago Monday and the current calendar might suggest that. Do you agree?
I have no view on extending the moratorium. I heard Mr. Greenspan testify that extending the moratorium would be a bad idea. I simply don't have a view on that right now. My hope would be that Congress would act as quickly as it could on the legislative proposals. Whether or not the moratorium is extended for several months is not something that I really have a clear view on.
What's your opinion of what we learned out of the events of 2 weeks ago Monday? There are arguments are made on the one side, and you were beginning to suggest those arguments that had commercial banking houses been able to become involved in investment banking, that it would have been even a greater disaster than it was, that would have pushed us into a whole variety of continental Illinois. You've heard those arguments. The argument on the other side is that had commercial bankers been involved with it, more adequate capital would have been available, and that would have been a stabilizing influence. I gather that those are the arguments on either side.
I think you have it, Senator.
Now, what's your position on that?
I don't have a firm position on it. What I would like to look at, and we're still looking at it, is whether or not we could put, at least on the security side, whether we could put regulations in place which would protect the securities affiliate from having capital withdrawn in times of crisis. Now that, we don't know whether that happened or not. I doubt that it did. From the banking side, I suppose one would want to look at the question of whether the collapse of a securities affiliate might pull the bank down with it. And that's a banking regulator's position, one which I don't know that we will be making a recommendation about. We would probably recommend that that question be looked at very carefully.
Well, Mr. Reuter, thank you very much for being here. And as Senator Riegel said, you've come in at an extraordinarily difficult time, and I respect the great problems that you faced and your fortitude this morning. Thank you very much.
Thank you.
One final question, if I may. In terms of the self-regulatory organizations, of course, which the SEC has to rely on to a very great extent to deal with the day in and day out operations of the marketplace, as we've gone through this severe period of difficulty in testing, how well do they seem to be functioning in your view, and does it look like, without, obviously we probably haven't been able to net everything out there, but does it look like there are some problems in that area, or do you feel quite well satisfied with the self-regulatory organizations in terms of how they have been performing, particularly over this last 2.5 weeks?
Unless I find something to the contrary in the studies, I would report myself as being highly satisfied with the functioning of the self-regulatory organizations over the last few weeks. I think they have been responsible and responsive and communicative, and they've been good listeners and good information providers. So I've been very, very pleased.
I would just say finally that I think all of us who have particular positions of responsibility in this area at this time, and certainly you carry a very major portfolio of responsibility for our government and our system and our people, as you well know. And I think it's essential that if we find here as we move along day by day that some of the things that need to be done aren't being done, that I think it's essential that every manner of effort be made to try to get those things to happen. And I think it's important for you to be forceful. That doesn't mean that you necessarily say anything publicly. It may or it may not. But the point is, I think to the extent things have to be moved around and moved into place here to stabilize this situation, strengthen confidence, shore us up against another real shock on the downside, I would hope that you would feel that you'd have the support of all of us here in the Congress and on the committee to be as forceful as you feel you need to be, and to be as blunt and as hard-nosed in talking with everyone that you have to deal with as the situation requires. I think you happen to be one of the few people here that can really create a sense of urgency when and where it needs to be created, and I would just urge you to recognize that as not only a critical responsibility, but one in which you'll have support, and that you'll not find yourself, I think, out there all by yourself. And so I would urge you to weigh that very carefully. And I want to say again, I appreciate the job you're doing. The number of times that we've spoken and your willingness to be forthcoming, your willingness to be forthcoming today, I think is very much to your credit. And these are tough days, and if we all work together, I think we'll get through them. And that's certainly the requirement that circumstances have imposed upon us. So thank you for your answers today, and we look forward to having you in here again.
Thank you very much.
You've been watching a hearing on recent developments in the securities markets before the Senate Banking Committee. If you'd like more information, you can write to the committee in room 534 of the Dirksen Office Building, Washington, D.C. 20510.